Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani, and in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads, the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include a building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. We have the deferred tax, current tax, bank interest. And then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial position as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually, we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember, this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with two items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items. One, we are told we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15. Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. So let's add what we have on the credit, 15,860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38 what? 40. So this particular 38.40, this is what? This is the loss on what? The loss on disposal. And what you're told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of account. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1. And you're told it is a policy. It is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months to the end of the year, the company provide a full year depreciation, but no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year, no depreciation will be provided as far as that plant is what? Concerned. But you're going to use that information in note 2. So let's go to note number 2. And you're told depreciation on property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%, using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? Based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 16. But now equally here, you have to recall, to remember, there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. That plant here. And basically we eliminated here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, 39,700 minus the accumulated depreciation, which is 15,860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%, using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do? We compute these particular depreciations. And remember in our case here, what you have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant. First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So and then to this we less now the net book value of the plant which was disposed, 23,840. Okay, and then we get 10% of that, which will give us 14, 14,500. How is this depreciation to be accounted for as per note number 2? This will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70, and that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. And this will give us what? 5,000. And equally, as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So, and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial control is a result of a decision which has been made by the board or basically by the management, and therefore such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative what? Expenses. And then you're told with the balance relating to the prior what? Year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debt written off. So in that case, we are told that is an amount of 12 million. Is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin. And then now the difference, which is 5 million, this one is a prior year adjustment. Basically what that means, this amount of 5 million, it relates to the previous year. We don't include it in the income statement for the current year. It's not an expense for the current year. So what we do, we adjust it in the opening the opening retained profit or the retained earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, the item of current tax, and you can see this is a debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what? Is under provision. Of what? Of current tax. Because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or other. Is upon you to know that other provision has a debit balance, other provision has what? Has a over provision has a credit balance. So therefore, that is over. That item which we have is under provision. So how do we treat under provision of a current tax from the previous year? So such under provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax what? Liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax what? Liability. That's basically what you need to know, and therefore that's what you are going to do as far as that under provision is concerned. And then you are told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million. 52 million is required, together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 what? Million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had under provision. The under provision which we have in the trial balance of how much? Of 26. And you have said that that under provision from the previous year, we added to the current year's tax what? Estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income what? Statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax what? Income. So because it's a decrease. Just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million. Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or what? Or expense. So we have that. Then let's move to the other note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue? So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of 1 share, 1 share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? By the company. The amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now what we are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, debited in the bank. That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000, times the par value. The par value is the amount or is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that would be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5. Times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically we can proceed and prepare what is required. So let's start with the part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which is given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 11,23,500. But remember, there is an adjustment which you're going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 11,03 500. So, but we can confirm that. Let's confirm whether that is correct. So we have 1123 500 minus 20,000 minus 20,000. That will give us 11,035 what 500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of sales. Cost of sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this we add any loss on disposal. Remember, here we have a loss on disposal, which is 3840. And any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000. 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 minus 14,500, and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we less that from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much would be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So we go through the items on the credit side of the trial balance. We see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here. And that is an amount of depreciation on motor vehicles is an amount of 14,000. 14,000. So this will give us a total of 58,000. So below the distribution we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500 500. So then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000, which is 5 what? 1,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year, the amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So I think now we can get the total administrative expenses. We have 93, 500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115, 500, 115, 500. And then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. 24. And then now what we need to do is we check whether we have any other expense or this company had any other expense which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory, purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was under provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax, current and deferred. That will be deducted from our profit before tax. And then number 6 is all about, number 5 is about closing inventory. We capture that there. Number 6 is about late issue. That do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598, 990 minus 58,000 minus 115, 500 minus 2400, and that will give us a figure of what? A figure of 423,090. So that is a profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of 2 components of tax. the current tax. And the current tax, we computed that figure there, which is 54,600. And then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income. And because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. The profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what? Is concerned, or part A of that question is concerned. So let's move to part B of that question. Part B, the examiner was requiring the preparation of the statement of changes in equity. Statement of changes in equity for the year, which ended 31st of December 2022. Now, remember, we say that this is prepared basically to show or to explain why there was a change in the various items of what? Of equity. In preparing this statement, we have said we start with the details column, and then we identify the items of equity our company had during that year. So items of equity include ordinary share capital and items of reserves. So if we go back to the trial balance, I think from where we have ordinary share capital, that is the first item, share premium, the second one, retained profits, that is the third one. Do we have any other like general reserve and revaluation reserve? No. So mean that in our case, we only have 3 items of equity, and then automatically we need to have what? We need to have the total what? The total column. The total column. So let's have those columns here. We have those columns here. I've said we have, we're going to have a number of columns. The first one will be the details column, and then ordinary share capital, share premium, and then retained what? Retained profit, and then the total column. Also our figures here, we indicate they are in thousands of shillings. So what do we start with here? We always start with the opening balances. Balances brought down. So the balances brought down, these are the figures we have in the trial balance. For ordinary share capital, the opening balance was 200,000. Share premium, 50,000. Retained profits, 223, 640, 223, 640. Then what we need to do, basically we get now the totals. So we have 200,000 plus 50,000 plus 223, 223, 640, and that will give us a total of 473, 6 what? 640. And then what we need to do is basically to take into account the transactions which occurred during the current year and which affected those items. The first adjustment which we need to make to this particular retained profit is what we were given in the additional information number what? Number 5. Not number 5, but not number 3, in relation to this particular budgets which was supposed to be written off, which related to the prior years. Remember, we said that this is a prior year adjustment. So therefore, the first adjustment we make is to adjust this opening balance with the prior year adjustment. We say that the prior year adjustment, these are the adjustments which were supposed to be factored in, to be taken into account in the prior years, in the previous years, but they were not taken into account. Remember, this amount of bad debts was supposed to be written off in the previous year, but it was not written off. So what we do is that we deduct it from the opening retained profit, and then from there we take into account the transactions which occurred during the current year. I think we can start by taking this right issue. The right issue 1, we said we need to add to the ordinary share capital, we add 40,000 because this amount was not accounted for, but it was credited in the suspense. And then to the share premium, we add what? We add 20. So that will give us a total of 60. We take it to the last what? To the last column. What else do we need to capture here? The profit for the year. The profit for the year here. The profit for the year. That will be added to the retained earnings at the start. And the profit for the is 371,490. And we take it to the last column there. Yes, that's what we have. What else do we need to capture here? In the trial balance, we have some interim dividends which were paid. So basically, we know that dividends are paid from the profit, and therefore we need to list them here. So the interim dividends paid as per the trial balance were 10,000. So we list them here, and also we take that to the last column. Do we have anything else we need to capture? We need to take into account here from the trial balance. Okay, from the additional information, note 1, note 2, note 3, note 4, note 5, note 6, note 7. Yes, I don't think we have anything else. So what we need to do here is basically to get now the balances carried down, and we say that these are the balances now which we transfer to our statement of financial what? Position. So let's get those balances. The ordinary share capital here, the balance at the end will be how much? Will be 240. What about the share premium? It will be 70,000. What about the retained earnings? The retained earnings, the opening balance is 223, 640, minus 5,000, plus 371, 490, which is the profit for the current year, minus the interim dividend, which is 10,000. So that will give us what? It will give us 580, 130. And then we get now the total there. The total you can work out all that, or you add across. So let's just add across, and then we will confirm whether it is correct. So these we add 70,000. We add 240,000. 240,000. 240,000. 240,000. Yes, so this will give us what? This will give us 720, 130. Maybe we can work this downward. We see whether that is the same figure we're going to have. 473, 640, minus 5,000, plus 60,000 plus 371 490 minus 10,000 minus 10,000. Is that what you're going to get here? No. So let's I'm getting a figure here of 890 130. So basically we can confirm again. So let's take 240,000 plus 70,000 plus 580 130 130. Yes, the correct figure should be this one. So that is 890 130. Yes. So basically that is our statement of what? Changes in equity. Our statement of changes in what? In equity. And basically that what was required in part B. Remember this is part B, not part A. Part B. So then finally we prepare now the statement of financial position. Statement of financial position. Position as at 31st of December 2022. 31st of December 2022. So this is quite simple because we have most of the items to be included here. For example, we have all the items of what? Items of equity. So when preparing the statement of financial position here, we said we start with the assets. First of all, we record the non-current asset and then current what? Asset. So what we start with are the non-current assets. The non-current assets, we need to have a single column here, and also we have to indicate that all our figures are in thousand of shillings. All our figures are in thousand of what? Of shillings. So these are non-current what? Assets. Non-current assets. So what we start with here, definitely we're going to start with the PPE, the property, plant and what? Equipment. And in our case here we have various items of PPE. We have property, we have plant, we have motor vehicle, we have office what? Equipment. So what we need to do as far as those items of PPE are concerned is we compute their total net book value at the end of what? Of the year. And basically we include that here as a single figure of what? The PPE. Remember what you have said here is that when preparing a statement of financial position for publication purpose, you don't record those items here separately. For example, you compute the net book value of plant, we include it here separately, plant the same. No, we don't do that. In fact, in an exam situation, if you do that, those items will not be marked for you. So what you do as far as the tangible and current asset are concerned, you compute their total net book value, all of them, and then you include that here as PPE. As what? A PPE. So let's start with the property. Property, the cost is 60. And because this property include building, we have now to less the accumulated depreciation of buildings at the start of the year. Or basically, we have to less the accumulated depreciation for buildings at the end. So what would be the accumulated depreciation for buildings at the end of the year? Accumulated depreciation at the end of the year. So in terms of how we compute this, we take the accumulated depreciation at the start, which is part of the trial balance, or which is in the trial balance, and then we add the depreciation for the current year. The depreciation for the current year for buildings is how much? Is 10. So this will give us a total of 90. So we let's start now from the cost. From the cost. Then to this, we add plant. Plant, that is, the cost is 2 what? Is 280. And then what will be the accumulated depreciation of plant at the end of the year? We take the accumulated depreciation of plant at the start as given in the trial balance, 111, 160, and then we add the depreciation for the year here. How much is it? 14.5. 14.5. So this will give us an accumulated depreciation of what? It will give us accumulated depreciation of 125, 560. So let's just confirm that. We confirm whether that is correct. That addition is correct. We have 111, 160 plus 14,500. So which will give us a total of 125,560. Yes. So we list it here 125,560. But also, as far as the plant are concerned, we have to remember something. There was a plant which was disposed, and that plant is part of this. So what we need to do, the plant which was disposed, we need to less it from this net book value which you are going to get. Can you remember the net book value of this plant which was disposed? I think we can compute its net book value. Its net book value will be 39,700, and then minus accumulated depreciation. Its accumulated depreciation of 15,860. So therefore, its net book value was 23,840. So what we have deducted here is the plant which was disposed because it was not accounted for. So then from there, we add the net book value of motor vehicles. So what will be the net book value of the motor vehicles? We take the cost, which is 70, and then equally we compute the net book value at the end. The net book value at the end will be equal to the the accumulated depreciation at the end will be equal to the accumulated depreciation at the start, 42, and then to this we add the depreciation for the current year. How much is it? 14,000. 14,000. So that will give us a total of 56,000. So we less it from the cost, which is coming to 56,000. We less it from the cost. And finally, we add office equipment. Office equipment, the cost is 40. And then we compute the accumulated depreciation at the end for office equipment. The accumulated depreciation at the start, as given in the trial balance, is 15. What about the depreciation for the year? 5. So the accumulated depreciation at the end for office equipment is 20,000. So we less that now from what? From the cost of 20,000. Yes. So that basically how we compute what? The net book value for the property, plant and equipment. Remember, property, plant and equipment here, these include all tangible and current assets. So let's work out that. We have 600,000 minus 90,000 plus 280,000 minus 125,560 minus 23,840. This is the plant which was disposed, plus 70,000 minus 56,000 plus 40,000 minus 20,000 minus 20,000 minus 20 what? 1,000 minus 20,000. So I think we can confirm that working so that we get the correct figure. Let's confirm that. So the first figure is 600,000. 600,000 minus 90, that is okay. And then plus 280,000 minus 125,560. 125,560 minus 23,840. Plus 70,000 minus 56,000 plus 40 minus what? Minus 20. Yes. So I'm getting a final figure here of 674 600. Yes. So that is the final figure for the PP. And then here we said we check for other assets like intangible asset, the investment, and so on. So let's go back to the information which we have in the trial balance. I think in the trial balance we have already captured the first items of PP: property, plant, motor vehicle, office equipment. Below that we have accumulated depreciations. And then we have in opening inventory, purchases, distribution, admin, revenue. We have already captured all those particular items here. Trade receivables, trade payables, those are items of current asset and current liabilities respectively. And then that bank balance, you can see that is an overdraft because the balance is on the credit side, is still a current liability. Deferred tax, that is an item of non-current liability Current tax, we have already captured that. Bank interest, we have taken into account that. And then ordinary share capital, share premium, retained profit, all those are items of equity. Interim dividends and suspense, I think we have already captured all those. So basically it means that we don't have any other item of what? A non-current asset. So what we need to do is we proceed and record now the items of current assets. So let's record current assets. Current what? Assets. So for current asset, we have a number of items. In the trial balance, we have trade receivables. Now the trade receivables in the trial balance is given as a figure of 74,500. But this figure will need to be adjusted with this particular amount of 12 million, which was included as part of the receivables, but you're told those receivables are non-existent. So we reduce our receivables with an amount of what? 12. So we deduct 12 here, which will give us 62,500. 62,500. Okay. And then from there we check whether we have any other item of current assets. So the bank balance which you're given in the trial balance, you need to know that that is a bank overdraft because it is on the credit side. The examiner will not tell you that. It is upon you to know that that is a bank overdraft and therefore is a current liability. Yes. In the trial balance, we don't have any item of current asset. What about the additional information? Number 1, you have dealt with that. Number 2, 3, 4. In note 5, we have the closing inventory. The closing inventory is included here as part of a current what? A current asset, which is 85. And then I think we are through. Yes, we don't have any other item. So what we need to do now is to get the total assets. To get the total what? The total assets. So let's add these particular items and PPE, and then the 2 items of what? The 2 items of current liabilities. So we have 674,600 plus 62,500. 62,500 plus 85,000 plus 85,000. So that will give us total asset of 822,100. 822,100. And then from there, we proceed and record what? Equity. Now for equity, this is quite simple because we have all the items of equity to be included here. From where? From our statement of changes in equity. So we just need to copy paste those items here. We start with ordinary share capital. Ordinary share capital, the balance at the end of the year was 240,000. We have share premium. Share premium. The balance at the end of the year for share premium is what? 70,000. 70,000. Then we have the retained profits. The retained profits. At the end of the day, it was 580, 130. And now what will be our total equity is what we have here. Total equity. Total equity. Total equity is what? Is 890. Is 890, 130. 890, 130. Okay. So then from there we proceed and we record the non-current liabilities. The non-current liabilities. Non-current liabilities. So which non-current liabilities do we have here? So for non-current liabilities, we say these include things like the bank loan, things like debentures, redeemable preference shares, and maybe something like the deferred tax. So what we need to check are the non-current liabilities which we have here. And in this question, we don't have bank loan, we don't have debentures, we don't have redeemable preference shares. I think in our case, we will only have one non-current liability, and that is deferred tax. And the deferred tax which we include here, first of all, if we go back to the trial balance, we are given a deferred tax of 32,400. But remember what we are told in note number 4, that the deferred tax provision is to be reduced with how much? With 3 million. So therefore, the amount of deferred tax to be recorded here, the amount of deferred tax which will be recorded here as a liability, we take the amount given in the trial balance, which is 32 400, and then we reduce this with how much? We reduce that with 3 million. So this will give us what? This will give us 29 400, and equally we can confirm whether that is working is correct. 32 400 minus 3,000. Yes, that will give us 29 400. So do we have any other non-current liability? I don't think so. We don't have any other non-current what? Liability. So finally what we need to record are the current liabilities. Current liabilities from the trial balance. We have what? Remember the liabilities have a credit balance. So check the items on the credit side. So one, we have the trade payables. The trade payables. The trade payables is an amount of 68,800. Then below that we have the bank balance, or basically the bank overdraft. The bank overdraft, and the bank overdraft is 15,500. 15,500. Yes, I think those are the two items which we have in the trial balance here. In the trial balance, and then in the additional information we check whether we have any other item of current liability. Note 1, we don't have any item of current liability. Note 2 is about depreciation. Note 3, and then note 4, we have the current tax for the current year. The current tax. So that tax, remember, had not been paid, and you are told in this case the company was supposed to pay, or the estimated tax liability for the current year was how much? Was 52. That's what we include here. Yes, and then note number 4 is about note 5 is about inventory. Note 6 is about what? About now the right issue, the amount of what? The right issue. So I don't think we have any other item of current liability to be included here. So what we need to do here is to get the total equity and liabilities, the total equity and liabilities. But there is something we need to adjust here. There is something which we added longly, because if you check on what we got here as the total equity, definitely you'll be able to see that that is more than total asset, which is basically long. So the figure which is wrong is this figure for retained earnings, or basically the retained profit. So there is something we added longly here. We need to make some changes quickly. So what do we have here? We have 138,000 plus 667,000 minus 85,000 plus 3840 plus 14,500. So that will give us what? That will give us 738. So this figure, instead of adding what we did, we deducted, which was actually long. So the correct figure here should be 738. 738 what? 340. So then we get the correct figure for the gross profit here. That was an error. So let's get the correct figure for the gross profit. We deduct that from our revenue, 1103 500, and that will give us now the correct figure for the gross profit here to be 365 160. So what else do we need to change? Our profit here before tax. Our profit before tax. So our profit before tax, we take 365 160 minus now the three expenses, 58,000 minus 115 500 minus 2400. So that will give us a figure of what? 189 to what? 260. And then we less the current tax, which is 54,600 plus the deferred tax income of 3,000. Yes, and our correct figure here for the profit for the year would be 137,660. Equally, that will be the total comprehensive income there. Yes, so that was basically a small addition, a mistake or error. So we also need to adjust this figure for the profit for the year, because the correct profit for the year is how much? Is 137,660. 137,660. So meaning that this will also change here. This will also change here. Those two figures will change. So let's work out this. The retained profit at the end of the year. So we take the opening balance here, 223,640 minus 5,000, which was the prior year adjustment, plus the profit for the year 137,660 minus the interim dividends which were paid of how much? 10,000. 10,000. So that will give us a figure of 346,300. Yes, and then we get now the total equity there. So we can work out that we take 346,300 plus the 70,000 which we have here, plus 240,000. 240,000. So that will give us now the correct figure here of 656,300. So therefore here we equally need to change this figure here. The retained earnings at the end, the correct figure is what? 346,300, and the total equity as per our statement of changes in equity is 656,300. I think now we can get now our total equity and what? Liabilities. So our total equity is 656,300 plus now the deferred tax 29,400 plus the payable 68,800. 68,800. I hope that figure is correct. Yes. Plus the bank overdraft, which is 15,500, plus the current tax 52,000. 52,000. 52,000. 52,000. So let's take that again. We start from equity there, 656,300 plus 29,400 plus 68,800 plus 15,500 plus 52,000. 52,000. Yes, that will give us what? That will give us a figure of what? A figure of 822 100. 822 100. 822 100. Yes, yes, yes. So basically that is it. That what was required as far as that question is concerned. That was an illustration question on the topic of what? Published financial statement. So basically that brings us to the end of that particular class. We meet in our next class as now we look on how we prepare the statement of cash flows. Remember what so far we have covered here is the preparation of the statement of comprehensive income, statement of changes in equity, statement of financial position, and then what is remaining is for us to discuss something to do with the statement of cash flows, the presentation of the same, and so on. So see you in the next class as we look on that.
Hello and welcome candidates to the lesson. The subject is Boardroom Dynamics. Today I'm going to start the revision of the paper that was done on Tuesday, 25th April 2023. Boardroom dynamics. Time allowed 3 hours. Instructions are as follows. Answer all questions. Marks allocated to each question are shown at the end of the question. Do not write anything on this paper. Do not write anything on the paper. So we're going to take a question at a time. This paper has 5 compulsory questions. The first question is a case study, and in April 2023 sitting, the case study about the Loden Cranes Incorporation. I'll first read the case, then we answer the questions below it. That is A, B, C, and D. First paragraph reads as follows. Lowe's Cranes Incorporation was founded in a small town in Kenya 20 years ago by a group of 10 engineers. The company specializes in the manufacture of various plastic items, including furniture and packaging containers. The 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden diversity in readiness for listing at the Securities Exchange. Independent directors needed to be added to the pool of directors. The achievement of board dynamics was greatly informed by psychological theories. Paragraph 2. The company was eventually listed at the Securities Exchange in November 2020. The founders were fully aware that the listing would allow them to fund and help sustain LKI's growth potential. The company has been growing its portfolio of products steadily, and currently it has over 100 lines of production domiciled in over 2 outlets spread across the country. Market capitalization of the company at the end of December 2022 was 517 million Kenya shillings. In the recent past, the company has been struggling in upholding good governance principles. The company has been facing integrity challenges. It has fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode where each department is more or less autonomous. Each employee is aware of the fact that there is no documented decision-making tool, a fact that brings about confusion, thereby affecting overall productivity. Meetings in the organization have been very informal. Despite the informal nature of meetings, many directors are highly skilled and dispense their business effectively. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on good corporate governance and board programs. Required: A, advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. 10 marks. B, examine 5 governance theories that could inform the company's board structure. 10 marks. C, analyze 5 skills that could enable the directors become more effective in handling their tasks. 10 marks. And lastly, discuss the essential attributes of the directors that were added to the pool at the company in order to achieve board diversity. We'll first answer part A. Advise the management of Lord King Cranes Incorporation on the tools that they may adopt to facilitate effective decision making in the corporation. Tools to do what? To facilitate effective decision making. Tools to do what? To facilitate decision making. That is part A of this question, the case study. The question is asking candidates to do what? To identify tools to facilitate. tools to facilitate effective decision making. Advise the management of the company on the tools that they may adopt to facilitate effective decision making in the corporation. In paragraph, the first paragraph, that is the third paragraph we read, that in the recent past, the company has been struggling in upholding good corporate governance. The company has been facing integrity challenges. It has also fallen back in terms of compliance with various statutory requirements. The company operates in a laissez-faire mode, all right, where each department is more or less autonomous. Every employee we read is aware of the fact that there is no documented decision-making tool. Do you see that? Every employee is aware of the fact. It is a fact that there is no documented decision-making tool. And due to that fact, there is a lot of confusion. The question is a factor that brings about confusion, thereby affecting overall productivity. So there is no documented decision-making tool. So the candidates are required to advise the management on the tools that they may adopt. The first one could be what we call decision-making frameworks. The company could adopt decision-making frameworks. Decision-making frameworks. What are these decision-making frameworks? Now, candidates, implementing structured decision-making frameworks can provide a systematic way or approach to resolving issues and making choices. And there are many decision-making approaches which we covered in our class. Remember, we discussed about the rational decision-making model. A good example is the rational decision-making model. That is one example of a decision-making framework. Rational decision-making model. There are many more, like the incremental decision-making model. Incremental decision-making model. The incremental decision-making model. We have the bounded rationality model. Bounded rationality model. The bounded rationality model is another example of a decision-making framework. The bounded rationality model. The incremental decision-making model. The rational decision-making model, and many more models. So by using such frameworks, the directors can evaluate options, they can consider potential risks, they can arrive at well-informed decisions, and so on. So these are some of the tools that we can discuss under point number 1. Then under point number 2 is what we call SWOT analysis model. The SWOT analysis model, where S stands for strength, W stands for weaknesses, O stands for opportunities, and T stands for threats. All right? This is a model that can assist or help the company assess its internal as well as external factors. The model aids in identifying areas that require improvement, that require understanding marketing trends, and making strategic decisions, providing directors with such information as far as the strength, the weaknesses, the opportunities, and threats of the company is concerned. SWOT analysis is yet another tool that can facilitate effective decision making. 3, decision support system. Decision support system, the DSS. DSS. The company can introduce the DSS software that can provide directors with analytical tools and real-time data for making informed decisions. The DSS candidates can help or assist in forecasting. The DSS can also help in scenario planning. It can help in risk analysis, thereby enhancing the quality of decisions. The DSS software. 4, governance policies. The company can put in place governance policies as well as procedures. Governance policies and procedures. Establishing clear and documented governance policies and procedures can create a framework for decision making. It also ensures transparency, it ensures consistency, it ensures accountability throughout the organization. Coming up with governance policies and procedures. 5, risk management framework. Another tool is developing a risk management framework. Implementing a risk management framework can enable the identification, can enable the assessment, and also the mitigation of potential risks. And that helps the directors make decisions while considering potential consequences and safeguards that the company may face. Risk management framework. Establishing a risk management framework is another tool to facilitate effective decision making. 6, task force and committees. Task force and committees. Setting up task force or committees to address specific issues can provide focused attention, can provide focused expertise for complex decisions. And such teams or committees can thoroughly analyze matters and propose recommendations to the board for consideration. That's one tool to facilitate effective decision making. The company may be faced with complex problems, complex situations. When that happens, then establish a task force. Set up a committee to look into the complex matter. Set up a committee to thoroughly analyze matters and propose recommendations to the board for decision making. 6 or 7, regular board meetings is another tool. Regular board meetings, formalizing board meetings with a structured agenda, with the minutes, ensures that all key topics are discussed, decisions are recorded, progress is monitored, and so on. Regular board meetings. These are additional points. Candidates were to give just 5. tools. I've given you 7. There are many more tools like expert consultations, seeking expert opinions and advice on critical matters can provide valuable insights and help in making well-informed decisions by the board. So these are tools to facilitate effective decision making. Number 1 is establishing decision-making frameworks. Under frameworks, I gave examples like the rational decision making model, the incremental decision-making model, the bounded rationality model. The second tool is SWOT analysis. The third tool, decision-making support system. The fourth tool, governance, policies and procedures, establishing governance procedures and policies. Number 5, risk management framework, putting in place a risk management framework, establishing a task force or committees to handle complex matters. I've also identified another tool which I call regular board meetings. Then lastly is the expert consultations. Let me put it down. Expert consultations. Expert consultations. Expert consultations. Any 5 points here could earn you the 10 marks. 10 marks. Any 5 points. Any 5 points. Even in point number 1, if a candidate was to explain the rational decision-making model, it would earn a mark. Incremental decision-making model, that would earn you a mark. The bounded rationality model, these are tools that facilitate decision-making. I'm now going to part B. Examine 5 governance theories that could inform the company's board structure. Governance theories. Examine 5 governance theories. 5 governance theories. Examine 5 governance theories. Governance. This was yet another easy part of this question. The first governance theory we know is agency theory. Agency theory. Now, this theory examines the relationship between the principals, who in this context are the shareholders, and the agents, who are the directors or managers. This theory emphasizes the interests of agents with those of the shareholders. It emphasizes aligning the interests of the shareholders with those of the agents. Why? In order to minimize any conflicts, ensure effective decision making in the company. Agency theory. I've said the theory examines the relationship between the principal, the principals, these are shareholders, and the agents, these are the directors or the managers. The theory seeks to align the interests of the principals and the interests of the agents so that there is minimal conflict between the principals' interests and the interests of the agents. That is the first governance theory. The second governance theory is stewardship. Stewardship theory. Now, in contrast to the agency theory, the stewardship theory views directors and managers as stewards who act in the best interest of the company. And according to this theory, directors are more likely to make decisions that promote the long-term organizational success and sustainability growth. Stewardship theory. Number 3 is stakeholders theory. Stakeholders theory. Stakeholder theory. Now, this theory, the stakeholders theory, emphasizes considering the interests of all stakeholders. Stakeholders are people or persons who have an interest in the company, people who have a stake in the company. And this could be the suppliers, the employers, the shareholders, the employees, the customers, the government, any person who is affected by the actions of a company is a stakeholder. The stakeholder theory, therefore, emphasizes the need to take into consideration the interests of all the persons who have an interest in the company, and not just the shareholders. Here, the interests of all the other stakeholders other than the shareholders should be emphasized. And adhering to this stakeholder theory can lead to more socially responsible decisions by the company. Adhering to stakeholder theory also improves the reputation of the organization. Stakeholder theory means or emphasizes the need to take into consideration the interests of all the persons who have a stake in the company. I've mentioned examples of stakeholders: the government, the employees, the suppliers, the customers, and so on. Resource dependency theory number 4. Resource dependency theory. Resource dependency theory is a 4th governance theory. Resource dependency theory suggests that organizations are influenced by external resources such as capital and expertise. And this company can use the Lord and Prince's company can use this theory to do what? To gain access or to diversify its network and build relationships with various stakeholders to gain access to essential resources. Do you understand? The resource, from the word resource, resource dependency theory, resource dependency theory. Resource dependency theory emphasizes or suggests that organizations are influenced by external factors, by external resources such as capital, expertise, and so on. Resource dependency theory. Number 5, contingency theory. Contingency theory. Contingency theory suggests that there is no one-size-fits-all approach to governance. There is no one-size-fits-all approach to governance. And the most effective governance structure depends on the specific circumstances of the organization. There is no one approach that fits all, or that can be applied in all the situations. Do you understand? Contingency theory. There is no one size fits all approach to governance. And that the most effective governance structure depends on what? On specific circumstances of the organization. And therefore, this company, for example, the Lord's Crinces Incorporation, can tailor its governance practices to suit the company's unique characteristics and challenges, because this company is unique. And therefore, the company should develop or come up with an approach that is unique to its challenges, that can address governance problems. So these are 5 governance theories that could inform LKIS board structure. 1, agency theory. 2, stewardship theory. 3, stakeholders theory. 4, resource dependency theory. Then 5, contingency theory. C, analyze 5 skills that could enable LKI directors become more effective in handling their tasks. Skills. The question is testing candidates' knowledge on skills that could enable directors become more effective. Skills that could enable directors become more effective. Skills that could enable directors become more effective. One important such skill is developing what we call strategic vision. Strategic vision. Strategic vision. Directors need to have a clear strategic vision for the company's future, and then align their decisions with the long-term goals. And that involves understanding market trends, that involves understanding competition, that involves understanding potential opportunities. A skill to understand the market trends, you require to have a skill to understand the potential opportunities and so on. So directors should have strategic vision, the long-term vision. They should have clear strategic vision for the company's future. That will enable them to become more effective. Financial acumen. Financial acumen is another skill. The directors should have strong financial literacy. A strong financial literacy, candidates, is essential for directors to analyze financial statements, to analyze budgets and investment decisions effectively. Directors may be called upon to make decisions related to investment. Directors may be called upon by the very nature of their job to analyze financial statements that are prepared by the accountants of the company. And to analyze financial statements, one needs to have financial acumen. One needs to have literacy, a strong financial literacy. And that's a very important skill that could enable directors become more effective. Communication and interpersonal skills, number 3. Communication is a skill that directors need to possess. Effective directors should be able to communicate their ideas. They should be able to communicate their concerns. They should be able to communicate their decisions clearly to the entire organization. We mentioned here, directors should have a strategic vision. This vision that the directors should have about the organization ought to also be communicated to the other members of the company, to other stakeholders. And therefore, the directors should have communication skills. They should be able to communicate clearly. They must foster a healthy relationship with the shareholders, with the management, and other stakeholders. And that can only happen if they have communication skills. They should be able to communicate their ideas, their concerns, their decisions clearly to the entire organization, to the stakeholders, and so on. Communication and interpersonal skills. Problem-solving skills, or what we call analytical skills, is another skill that could enable directors become more effective. Number 4, analytical skills. Problem solving or analytical skills. Problem solving skills or analytical skills. Problem solving. Directors should be skilled in analyzing complex situations, analyzing complex issues. The directors should have skills in identifying challenges. The directors must have skills in proposing effective solutions to the challenges. The ethical standards is essential for directors, especially in addressing integrity challenges faced by the company. So ethical decision making ensures that the company operates with integrity and also maintains a positive reputation. Because we all know by now that a positive reputation is an asset to any organization, is an asset to any person. One who holds ethical or one who is has high standards of integrity. A company that upholds ethical standards is a company that is likely to maintain a positive reputation, and is a skill that directors must learn: ethical decision making. So these are 5 skills that could enable the directors of this company become more effective. Strategic vision, number 1. Number 2, financial acumen. Number 3, communication and interpersonal skills. Number 4, problem solving or analytical abilities. Then number 5, ethical decision making. Ethical decision making. So that is part C of that question. Part D, discuss the essential attributes of the director that were added to the pool at LKI in order to achieve board diversity. All right. We read in the question that meetings in the organization have been very informal. During their last meeting, the directors resolved to schedule capacity building sessions so that they could be trained on governance, good corporate governance, and board programs. So the question here is, discuss the essential attributes of the directors. D. Essential attributes of directors that were added. So there are directors that were added to this board because we read that the 10 founders of the company became the directors of the company and held all the top leadership positions. After 3 years of operation, they decided to broaden board diversity in readiness for listing at the Securities Exchange. They decided to do what? To broaden the board diversity in readiness for listing at the Securities Exchange. The achievement of board directors was greatly informed by psychological theories. The question is, what are the essential attributes of the directors that were added to the pool? The first attribute is diversity in backgrounds. Diversity in background. One, background diversity. When new directors were recruited, one important attribute to look at, or that was looked at, was the diversity in their backgrounds. The new directors should come from various professional backgrounds, from various industries and experiences, because this diversity brings different perspectives, brings different expertise to the board, and thereby promoting innovative thinking. Innovative thinking. Two, inclusive mindset. Inclusive mindset. Directors with an inclusive mindset actively seek to understand and also to appreciate diverse viewpoints. Such directors should value contributions from all board members, regardless of their backgrounds. So directors that were included should be ones that have what we call an inclusive mindset. This is a mindset that tolerates diverse opinions. Do you understand? 3, industry knowledge. Industry knowledge. Adding directors with relevant industry knowledge and expertise can help this company to navigate challenges specific to their sector and also stay competitive. 4, another essential attribute is that of independence. 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 Directors of a company should have independent mind. Independent mind. Why? Because independent directors are crucial for maintaining impartiality and avoiding conflicts of interest. They should not only have affiliations, but also financial interests or ties to the company. So when recruiting the new directors, an essential attribute that should be considered, or that was considered, is that of independence. The directors ought to be independent. 5, governance experience. Governance experience. Directors with prior governance experience bring valuable insights into the company. They bring into the company what we call best practices and can help the company improve its governance standards. And therefore, candidates, by embracing these diverse attributes, the company can benefit from robust discussions, the board can benefit or can make better decisions, and also enhanced governance practices. So these are some of the essential attributes that were added, that were considered when adding new directors to the company. Number one, background diversity. Number two, inclusive mindset. Number three, industry knowledge. Number four, independence. Number five, governance experience. How many marks? This should earn 10 marks. 10 marks. So these are 10 marks. Part C, 10 marks. Part B, 10 marks. Giving us a total of 40 marks. So this is the case study that was tested in April 2023. The subject is Boardroom Dynamics. The course is Certified Secretaries. Thank you for attending this lesson. In our next lesson, we're going to answer question number 2 from the same sitting. Bye-bye. Hello everyone and welcome to the lesson. The subject is Boardroom Dynamics for Certified Secretaries. We've been answering questions from the past paper that was examined in April 2023. So far we've done question 1 up to question 3. Today I'm going to answer question number 4, which part A reads, the broad substance of the Cadbury's report of 1992 emphasized that an approach based on compliance with voluntary code coupled with disclosure will prove more effective than a statutory code. With reference to the above statement, explain 4 recommendations in this report which have been adopted by public companies. With reference to the above statement, explain 4 recommendations of the Cadbury report. We are answering questions from the April 2023. This is question number 4, part A. Four recommendations. That's the question. 4 recommendations of the Cadbury report of 1992. 4 recommendations that have been adopted by public companies. The first one is in relation to the composition of the board. 1, board composition. That is one of the recommendations that have been adopted by corporations. Board, number 1, board composition. The report recommended that boards should be composed of a balance of executive and non-executive directors, because non-executive directors bring independent oversight and diverse expertise to the board, reducing the concentration of power in the hands of the executive. The report recommended that a board should be composed of both the executive and the non-executive directors. The second recommendation is on the role of the executive directors. The role of non-executive, directors. This report emphasized the importance of non-executive directors in providing an independent judgment on issues, especially related to executive remuneration and appointment of executive directors. The role of non-executive directors is very important as far as the Cadbury report is concerned. Role of non-executive directors. Another recommendation is in relation to the audit committee. Audit committee. The audit committee. The report recommended that there should be established an audit committee comprising of non-executive directors. The audit committee should comprise what? Non-executive directors. And these committees are responsible for overseeing the financial reporting, overseeing internal controls and risk management, and thereby enhancing transparency and accountability in the company. Audit committees. That is one of the recommendations of the Cadbury report. 4, remuneration committee. The remuneration committees. Now, the Cadbury's report recommended that boards should set up remuneration committees to determine executive pay, ensuring that it is fair, reasonable, and linked to the company's performance. And this measure, candidates, is aimed to address concerns about excessive executive compensation. So these are 4 recommendations of the Cadbury report of 1992 that has been adopted by many public companies. 1, board composition. 2, role of non-executive directors. 3, audit committees. And 4, remuneration committee. 4 recommendations. How many marks? 4 marks. 4 recommendations, 4 marks. Part B reads, examine 5 ways of ensuring effective board succession. 4 ways of ensuring effective board succession. 4 ways. 5 ways, not 4 but 5 ways. B. 5 ways of ensuring effective board succession. The first obvious way is succession planning. Succession planning. Succession planning. We are discussing ways of ensuring effective board succession. The company should develop a structured and comprehensive succession plan that identifies potential candidates for executive and non-executive roles within the organization. And that plan should consider both the short-term and long-term talent needs. Succession planning. Talent development. Number 2, talent development. The organization should implement leadership development programs, and the purpose of these programs is to groom and nurture potential successors. Such programs should provide training, should provide mentoring, should provide exposure to different areas of the business to prepare individuals for future leadership roles. Talent development. The managers should be developed. Talent, they should be trained. So that is another way of ensuring effective board succession. Talent development. 3, board evaluation. Board evaluation is yet another way of ensuring effective board succession. Board evaluation, the board should conduct regular board evaluations to assess directors' performance and also identify areas for improvement. Such evaluation process helps identify potential gaps. These are gaps in skills, gaps in experience that needs to be addressed during succession planning. Carry out board evaluation with the view of identifying any gaps so that if there are any gaps, they can be filled, and that can help in effective board succession. 4, external search. External search, or we can say external recruitment. Recruiting from external sources. The company should consider external candidates when seeking to fill board vacancies. Why? Because external directors can bring fresh perspectives, can bring diverse expertise to the board. They can also complement the existing skill set. So that's another way of ensuring effective board succession. Recruit from external sources. Another way is what we call board diversity. Board diversity. The company or the board should promote diversity in the boardroom, including diversity in skill, experience, background, demographics, and so on. Why? Because a diverse board can foster innovative thinking and adaptability, contributing to effective succession, board succession. So these are 5 ways of ensuring effective board succession. Number 1, succession planning. Number 2, develop talent. Number 3, board evaluation. Number 4, external recruitment. Then lastly, board diversity. These are 5 ways, 5 marks. 5 ways, 5 marks. That is part B. Then part C reads, discuss 3 types of corporate culture. Types of corporate culture. I'll answer it here. Types of corporate culture. The first type, these are types of hierarchical culture. The first type is hierarchical. Hierarchical culture. From the word hierarchy. Hierarchical culture is one of the types of corporate culture. Here, candidates, the organization has a chain of command and decision-making authority, which is concentrated at the top. And such culture values compliance with rules and procedures and communication. In such a culture, typically flows from top to bottom. And employees are expected in such a culture to follow directives from their supervisors without questioning them. Hierarchy. Information flows top down. Top to bottom. Top to bottom. Hierarchical. In a hierarchical culture, I've said the organization has a clear chain of command. And decision-making authority is concentrated at the top. Such culture values compliance with rules and procedures, and communication flows from top to bottom. That's one type of corporate culture. Then number 2, we have innovative culture. innovative culture. Now, an innovative culture encourages creativity. It encourages risk-taking and continuous improvement. And in this type of culture, employees are empowered to think outside the box. They are encouraged to propose new ideas and experiment with the new approaches. And here, candidates, there is a focus on adaptability and embracing change in order to stay ahead of the competition. Innovative culture, thinking outside the box. 3, customer-centric. Customer-centric culture. Customer-centric culture. Now, a customer-centric culture prioritizes the needs, prioritizes the preferences of the customers. Here, the organization emphasizes delivering exceptional customer experiences and aligns its strategies with customer satisfaction and loyalty. So, in such a culture, employees are encouraged to listen to customer feedback and make decisions that prioritize customer interests. So these are 3 types of corporate culture, and it's important to note that corporate culture can be a blend. It can be a blend of these 3 types of culture. It can be a blend of the 3 types of culture, or may vary across different departments or even divisions within the same organization. For example, you may have the marketing department developing a customer-centric culture, because the marketing department is in touch mostly with the customers. So it may vary even within the divisions of the same organization. And the candidates, the culture plays a significant role in shaping the behavior, in shaping values, in shaping the organization. And also the values. Culture can also shape the values. It can shape the overall performance of the company. So these are 3 types of corporate culture. Hierarchical culture, number 1. Number 2, innovative culture. Number 3, customer-centric culture. Customer-centered culture. Customer-centric culture. These are 3 types of culture. 3 types of culture. How many marks? 6 marks. Corporate culture, 6 marks. So that will mark the end of the revision of boardroom dynamics for certified secretaries. We've done question number 4. That was examined in April 2023. Part A, 4 marks. Part B, 5 marks. And Part C, 6 marks, giving us a total of 15 marks. In our next lesson, we are going to answer the last question. That is question number 5, which again is in 3 parts. Part A reads, describe 3 standards of good corporate governance as stipulated by the Capital Markets Authority Code or its equivalent. Number 3, determine 4 situations where avoidance would be the most suited method to manage conflict, 4 marks. Then lastly, explain 4 benefits of evidence-based decision making, 8 marks. Try to attempt question number 5 before coming into the next lesson. Thank you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the business and data analytics April 2023 question 22. It reads as follows: you work as a management accountant for Majani Limited, which deals in tea production and export. Before embarking on next year's budgeting, you are tasked with analyzing past revenue and price trends. As a starting point, your supervisor has provided you with historical price and production data as shown in the worksheet. So you can see the dates have been given to you, the production, millions of kilograms, prices per kilogram. We move down and see what we are required to do. A, plot a line graph for price against time or dates. Insert a linear trend line displaying the equation and R squared on the chart. Briefly discuss your results. So we go back up here and pick the relevant data. We start with the dates, move down like so. Then we go back up again and pick the prices. But before we pick the prices, we need to press Control so that now it can jointly pick the dates and the prices at the same time. So you can see as I press Control. Then you hover around Insert, click on Insert. Then you come to Line Chart. This is what to say, the line chart. So you click on it. Then you proceed on to click whichever chart pleases you amongst this list of for line charts. So let me click on the first one. So as you click on the first one there, we just need to just be patient a bit so that now the output like so can actually come out. So what we do, we just place this where it's supposed to actually be, next to the solution, ladies and gentlemen, there. And moving like so would mean that we would be able just to place the data where it is actually supposed to be, which is right over here. So what are we told? We are told that we need then to plot the line graph. That's okay, we've done that. Insert a linear trend line displaying the equation and R squared. So we need to display the equation and R squared. R squared represents the coefficient of determination. Coefficient of determination assists the investment expert or the accountant to identify whether the regression is reliable. So we go back up here and we just right click on the graph. We add a trend line right here, and when we click on this like that, the trend line should be able to appear. As you can see, moving towards the right here, the trend line appears. We can then now display the equation. So you can see all of these inputs over here. There's either exponential, there's linear. Linear is what we've been told that we need to do. The trend name, we just say it is the linear price per kg, which is okay. Then we move ahead and say that we need to display the equation, which is there, we tick that. And then we also display the R squared over here. So we tick that. That's what we've been told by the examiner. And then we can close this part here, close it. And for a clearer picture, we can place the equation just above there like that. And then also what is going to appear is going to be the R squared. Now that's much clearer as compared to where it was initially placed right there. So this is our part A. We can then move ahead and try and identify what we've been asked for part B. For part B, we are told, using a suitable MS Excel function, show that the coefficients shown in the trend line in A above are in fact a result of a linear estimation between historical prices and time. So what we do is that there is what is called a leanest function over here. So we move this over here like this. Say this is part A. Like that. So we can put over here part B. And we now use the leanest function plus leanest. So what is leanest? We are saying that the leanest represents linear estimation in full, and this value returns the statistic as it's shown over here. It returns the statistics that describe a linear trend matching known data points by fitting a straight line using least squares method. So what we do is that we then now need to identify what our y value is. Our y value represents the prices per kg. So come over here and highlight everything there for known y's. That. And then we go back up. Our known x's. Our x's are influenced, are the what we call the independent variables. They're the ones that influence the y's, saying that the dates and the production in kgs, we highlight both of them together like so. And then clicking on this part over here called constant here, it represents a logical value. And we say true over here. True. That. And we say okay. So we are told that an unexpected error occurred. So we just click OK here, because we are saying that we are getting negative 0.74. And this is the formula for the linear estimation. So linear estimation right here. And we say leanest. Like so. Leanest. And we can be able to put it like so. And put it in form of maybe say perhaps maybe you can be able to just highlight maybe in a different color and maybe just for presentation purposes there. So you can put it like so. Then maybe you can proceed on to put it in form of a thick square outside there. So we expect that this 0.7412 should actually be the same as the value right over there from the equation. So moving on, we can then move on to part C. Part C, you can see that you know that prices are affected by production. Because of this, you would like to run a regression between price, production, and time. Use data analysis tool pack to run the regression analysis, interpret your results. Be sure to discuss the coefficients and the parameters. So what we do is that we run a regression, part C here. Like so. And then we pick the dependent and the independent variable. So the data analysis tool pack is under the data tab here. Click on data. Then on the far right, you can see data analysis. Click on data analysis. And then you search for regression right here. You can see regression is right there. Click OK. What is our Y input range? The prices. So we click the prices like so. And then our X input, click there. We go back up again, and we can see that both the dates, this is a multiple linear regression, the dates and the production levels are the ones that influence prices. That. So if perhaps you would want the labels, be able to put in labels over there like that, and then we click OK. So we have this output. So you can copy this output right over here and place it as appropriate on question 22 right under part C here. Control V. And we are saying that we can be able to see these regression statistics, R squared, which represents coefficient of determination. The standard error has also been given. We also have number of observations, so 154. That. And here is what we have as the intercept right here. We have the intercepts right over here. Then we have the dates over here. So you can change this to dates. And here you can be able to say production and millions per kgs production. Kgs. That. When x is 0, what is the value of y? Then that's what is represented by the intercept there. The dates are coefficients that influence the prices, the dates as well as the production in terms of kg. So we are saying that you can see this is the intercept and the date and the production per kg. That. Notice that under leanest over here, we expect negative 0.074. That. So 0.074 should be the part of the intercept right there. We can now move on and understand or analyze the p-values here. Come to home and we come like so, we do like so. We are saying that low p-values less than 0.05 means that the coefficient is likely not to equal 0. But if we have high p-values greater than 0.05, then we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. In terms of the F statistic over here, we need to look at the F statistic in collaboration with the p-values. The F statistic, or rather, when you're saying that because the p-values over here are greater than 0.05, with the exception of this production of kgs, then the model might not be reliable for analysis, or might not be used for analysis. When we look at the R squared, our R squared is given to us right over here. I can highlight that over there. And we're saying that we want our R squared. If R squared is greater than 0.95, then the regression should actually be reliable. In our case over here, it is not greater than 0.95. And hence the model is not reliable for analysis. It cannot be used to predict the future production levels. So what can we conclude from that analysis? We can conclude that the model is not good, because we are saying that the R squared is not greater than 0.95. Secondly, we are also saying that the p-values right over here, because most of them are actually greater than, all of them are actually greater than 0.05, all of them 0.05, we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. We can also conclude that innovations can be, for example, to remove this constant value over here, to try and evaluate and estimate if the value is okay, or we can be able to use other metrics or other time series data to analyze or make inferences of this data that we're analyzing towards our left. So that is it for question 22. We hope that you have enjoyed it and you've understood how to run a regression. Thank you for being with Manifested Publishers. Be blessed. Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lengwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost, 40 million. Residual value, 2.5 million. Selling price per unit is 1.1. Variable cost per unit, 500. I meant 1,100, pardon me. Then variable cost per unit is 500. Fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, or the major inputs towards the right. Like for example, what I mean is this. We're going to now talk about the base. Here we're going to talk about the base case, input based on the input, so base. That. And then towards the right, we're going to include a 5% initial cost, or positive value of 5% initial cost. So we're going to have plus 5% initial cost, like that. And then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost. 5% variable, 5%. I'll explain variable cost. And then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here, of 5% variable cost, and then residual value. There, so negative 5%, negative 5% residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. positive 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. Like that. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value going down. The residual value is given to us over there. That value there. Because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus. Enter there. The project life in years. We have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this. To do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, and I can just do away with that, or rather I can just put them beside the questions over there. However, we can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us. 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on. And even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1,100 like that. So I can just copy these values as the way they are towards the right there, with your permission. Because we are saying that the initial cost is the one that is only increasing. So here, just a copy, paste special values. Let's say okay, like that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5%, like that. You can see it's even indicated to us over here. So here we are saying is going to come back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now, right down over here, we can now do the workings effectively. So, can say plus that value times 1 plus it should be because you're decreasing this value over here 1 no so this is the formula, it's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be, we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We took about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us them. It should be able to give us take us back to where we actually were before, were there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price. Sorry, so negative 5%. So we put that, and it remains the same over here. I'll explain that. If you're talking about the variable cost itself, also it also remains the same like that. So it's going to remain including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item. Talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. And so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because we are saying that the unit sales are the ones which are being affected. The sales, we are dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change, pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we're saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, then we enter. Then we remain with enter. We have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we're going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Base, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because we're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one, where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here. Total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. You remember it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with your permission, I'll just move this a bit towards the right. For here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we're going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we said that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows: 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So I should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so we can put it year 5 is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1 times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this. It's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here you put that, and we 12%. So it's going to be plus the cash flow and then we discount. We are discounting it. Discount it against open the brackets 1 plus that value, close the brackets, power 1 times, not times the cash flow. It's already been multiplied like that. So we enter. So once we have that, we shift Control R. That is year 1. Notice what I've done over here. You can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one power 2 that. Then you do the same thing. One plus R power 3 that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4 that. Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can say PVIF, value interest factor, year 5 times cash flow. That's what you do. So this is residual value. I should change this to enter. Just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can see that we're getting the total present value. Present values is going to be those ones there like that up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that. Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, you're saying plus, should I say plus or should I say minus? So you say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever you calculated over here. You can see it's 42 million. So we'll just change Control R, that, we get the NPV. Put it, Control B, then you put a top and bottom border, plus then it may not be very clear, so I put that thick border there, and then I put also this other border here with the permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that, then we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case, so we'll have, so part B here, I can do it just down over here. So the base, we'll just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, the initial cost was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. There. So we cannot have an adverse effect for the initial cost. We cannot, unless the cost is an adverse effect, means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost. The only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs each scenario can be above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once you go to insert, we can come to recommended charts. Click on recommended charts. And you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. And we say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we are selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you.
Candidates, welcome to the lesson. For those of you who are joining for the first time, we have been answering questions from the April 2024 sitting. So far we've done question 1 and question 2. Today we're going to answer question 3. Question 3. It's my hope you have the question papers which we had shared in the WhatsApp group. Make sure you print the papers if you have not printed, so that when you appear in these lessons, have the hard copy. Okay. Now let's begin. Question 3A. Explain the following option trading strategies. Explain the following option trading strategies. Roman 1, bull spread. Roman 2, bear spread. Roman 3, covered call. Covered call. 2 marks each. Now these were brief questions on option trading strategies. The first one is bull spread. Bull spread. Now, before we explain the bull spread, first of all, what is bullish market or a bullish investor, and who is a bearish investor. That by understanding, first of all, a bullish investor, we will be able to easily understand the bull spread. Now, first of all, in the context of financial markets, bullish refers to an investor or a market sentiment that expects prices to rise. And therefore, a bullish investor is optimistic. A bullish investor is optimistic about the future performance of a particular share or stock or market or asset class. They believe that prices will rise and are likely to buy or hold on to assets in anticipation of gains in future. That is a bullish investor, is one who expects that the prices will rise in future and therefore is likely to hold on to an asset, hoping that when the prices increase in future, is likely to gain. Now, having understood a bullish investor, then what's the meaning of bull spread? Now, bull spread, as the question suggests here, is an option trading strategy. Okay? Bull spread is an option trading strategy. All right? First of all, it is an option trading strategy and is used when an investor expects a moderate rise in the prices of the underlying asset, and it involves buying and selling two options of the same type, but with different strike prices. So that is a meaning of bull spread. Then Roman 2, we have the bear spread. The bear spread. Now, to understand the bear spread, we ought first of all to understand a bearish investor. A bearish investor. Now, bearish is the opposite of bullish. It is the opposite of bullish. You recall we say that a bullish investor is one who is optimistic about future performance of a particular stock or asset. But we are now saying a bearish investor is the opposite of bullish. And bearish refers to a negative or pessimistic outlook on the future performance of a particular stock, market, or asset class. So a bearish investor believes that prices will decline and is likely to sell or avoid buying such an asset in anticipation of such losses. That is a bearish investor. And therefore, what is a bear spread? Now, a bear spread is just like a bull spread. It is an option strategy that is used when an investor expects a moderate decline in the prices of an underlying asset. And it involves buying and selling two options. And the two options are of the same type. Do you understand? That's the meaning of bear spread. Then Roman 3, we have covered call. Now, a covered call is also an option trading strategy. where an investor holds a long position in an asset and sells call options on that same asset in order to generate income from the option premiums. And that strategy is used when the investor expects the underlying asset to have very little or no price increase. That is the covered call. That is a covered call. Now, that is part A of the question, 2 marks each. Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of 129 million shillings. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So we have 3 years expected results: sales, cost, cash costs, capital allowances, interest charges. We have cash flows to replace assets and finance growth. Additional information number 1. From year 4 onwards, from the 4th year onwards, it is expected that the annual cash flows from Small Limited will increase by 4% each year in perpetuity. Number 2, tax is payable at the rate of 30%. Tax is paid in the same year it falls due. 3, if Duet Limited acquires Small Limited, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as a proportion of total equity plus debt. 4, the cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. 5, the risk-free rate of return is 6% and the return on the market portfolio is 11%. Required. Roman 1. The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on a forward price earnings multiple of 8 times, 2 marks. Roman 2, the cost of capital of Duet Limited, 4 marks. Roman 3, determine the offer price for Small Limited using discounted free cash flows valuation method. That is the question. All right, 8 marks. Now this one was relatively the easiest question in this sitting. It was relatively the easiest because question is direct. It's very direct. Look at Roman 1. The offer price for Small Limited, offer price. Assuming Duet chooses to value Small Limited on a forward price earnings, right? That is the PE multiple of 8 times. Now that means that Duet Limited is considering buying Small Limited and is issuing or using a valuation method based on the forward price to earnings ratio. Forward price to earning ratio. This is only 2 marks. I'm just taking time to explain, help you understand the question. But the answer is very simple. So we just take 8, then multiply by the earnings of this company. It will be 129 million times 8. That is the answer. But I'm taking time to explain so that you understand that the forward price to earning ratio is a method that is used when valuing targets. Okay? The duet is going to use evaluation method based on the forward price to earnings ratio. And the candidates, in valuing the target, the company estimates a company's value by looking at its predicted future earnings. Predicted future earnings. That's why in the first sentence we read that this company is expected to have earnings next year of 129 million. You understand? So this is the answer. This is a Roman B Roman 1. The offer price. The offer price. The offer price will be equal to earnings of the target times the PE ratio. And the earnings of the target, from the first sentence, we get the earnings of the target, 129 million. So 129 million times the ratio. The PE ratio is 8. The multiple is 8 times 8. And that is the answer. 2 marks. We just picked it directly. A forward price earnings multiple of 8 times. So how much is it? 1032. That is 1 billion. 32 million. 1032. 1 billion. 32 million. 1 billion and 32 million. Yes. Agostino, that is correct. Kelvin, that is correct. So that is the answer, 2 marks. Roman 2, the cost of capital. The cost of capital, Roman 2. So when you have such a question, step number 1, put down the formula. Cost of capital, Roman 2. We are to calculate the cost of capital. Now, this is a geared firm. It is a geared firm. And in Roman 3, we read that if Duet acquires Small Limited, it estimates that the gearing after acquisition will be 35%. So the proportion for debt will be 35%. Okay, which means the proportion for equity will be 1 minus 35%. So this is a geared firm, and therefore we have to calculate the weighted average cost of capital. The cost of capital of a geared firm is the weighted average cost of capital. The weighted average cost of capital, which is equal to the weight of equity, weight times cost of equity, plus weight of debt times KD. That is the formula. So first of all, put down the formula. So the cost of capital of this firm, given that it's a geared firm, will be the weighted average cost of capital. And this is the formula for the weighted average cost of capital. Then we check from the question if we have the weights. And we have just read in note number 3 that the weight for debt is 35%. If the weight for debt is 35% proportion, then for equity will be 65%. So we have the weights. These weights we can pick from the question. Then do we have cost of equity? No, we do not have the cost of equity. What if Agostino asks, what if it was not a geared firm? How would the formula be? How would the formula be? If it was not a geared firm, it would depend, Agostino, on the information provided. And I'm just going to show you right away. Assuming that it was not a geared firm, then the cost of capital will be the cost of equity. Okay, if it was not geared, that would mean that the capital structure, in the capital structure of this company, will only have equity. And therefore, the cost of capital will be the cost of equity. Is that clear? Now, to even illustrate it, Agostino, let us assume there is no debt. Let's assume there is no debt in the capital structure. Therefore, what will be the cost of equity, given the information we have? You can see from this formula, we have the weight. The weight of equity is 0.65. The weight for debt is 0.35. Do we have cost of debt from the question? Yes, in Roman number 4, there is cost of debt of 7.4% before tax. So this cost of debt is 7.4. So we multiply this by 7.4% before tax. And what is the tax? The tax is 30%. So we deduct it. 1 minus t is 0.7. So this will give us a element of debt. Then we have to calculate now the cost of equity, which we are not provided in the question. And that is what Agostino is asking. What if it was not geared? What if it was not a geared firm? How would the formula be? Now, Agostino assumed that this one is not, it is not geared. We only have equity, this equity. What will be the formula for calculating equity? Now, to calculate equity, we need the working. To calculate this cost of equity, we need to have a working, and we are going to use the CAPEM formula. Using CAPEM, KE should be equal to RF plus RM minus RF times beta, equity beta. So we have to use this CAPEM formula to calculate the cost of equity. Now let's check from the information provided. Do we have the risk-free rate? Yes, note number 5, the risk-free rate is 6% plus. Do we have the return? The return on market portfolio, we have it 11% minus 6. Then there is a note number 4, Equity beta is 1.6, 1.6. So that is the cost of equity. How much is it? What is the rate? Hope says 14%. 14%. Is that true? Can someone confirm? Is it 14%? I need confirmation. Correct. So this is the cost of equity, 14%. With that, we can now calculate the weighted average cost of capital. How much is it? 10.913%. Correct. 10.913% is the cost of capital. Is the cost of capital, 4 marks. Cost of capital, 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Can we proceed? I told you it was one of the easiest of all the questions. Roman 3. Determine the offer price for small limited using discounted free cash flow valuation method. And you can see, candidates, this question is directing you. Discounted free cash flow. That tells you that to determine the offer price, you are going to discount the cash flows. Discounted free cash flow valuation method. You understand? The offer price for small limited using the discounted free cash flow valuation method refers to the present value of small limited's projected future free cash flows. And in essence, the discounted cash flow valuation method aims to determine the intrinsic value of small limited based on its ability to generate cash flows in the future. And this method is widely used in mergers and acquisitions because it provides a comprehensive and theoretically sound approach to valuation of companies. You understand? So we're going to discount the cash flows, and the cash flows are provided in the question. Look at the second sentence. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. Okay? So, Roman 3, the offer price. Okay? Offer price. Now, to calculate the offer price, we have seen we are going to discount these cash flows, and that will enable us determine the offer price. So you can see from the question we have 3 years. So one column will have the years. There are 3 years. 1, 2, 3. Then the next column will have the cash flows in thousands. We'll have the cash flows. This cash flows. Then we'll have the present value interest factor. The present value interest factor. And the rate that we computed in Roman 1, that will be the discounting rate. This is the discounting rate. Okay? Present value interest factor, 10%, 10.913. N. Then we'll have the present present values. You have the present values in 1,000. So that is the formula. Okay. Are you following? To determine the offer price using the discounted cash flows valuation method, we'll have the years as given in the question. We'll have the cash flows, the future values of cash flows year one. We will discount using the present value interest factor 10.913%, and then we multiply by this factor by the future values. That will give us the present values. Then this total down here will be the answer. That will be our answer. So that is the formula. Okay. Cash flows. Can we proceed? Can we proceed? Can we proceed? Are we on the same page up to that point? Year one, year two, year three. But you recall there was a statement on something to do with year four onwards. Yes, not number one. From year four onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. So from year four onwards, there is year from to perpetuity. From year four onwards to perpetuity, they will also have the cash flows. So do we have the cash flows? No, we do not have the cash flows. We have the sales, the cash. So we need to calculate the net cash flows. So we are going to have a working for the net cash flows here. Workings. We are going to calculate the net cash flows. Net cash flows. The net calculation of net cash flows. We are going to have calculation of net cash flows. That is the working. Because here we have sales, year 3, year 3, year 2, year 1. Thousands, in thousands, in thousands. So what we have here, we have sales. These are sales, 300 million, 300 million, 420 million, 480 million. After sales, there is a cash expenses. Cash expenses. We deduct the cash expenses from the sales. 180 million, 240 million, 270 million. Then we also have the interest charges. Interest charges, 15 million, deduct 15 million, deduct 15 million, deduct. We then deduct the interest charges. Okay, interest charges. Are we following? That clear? We are calculating the net cash flows, which we need to discount here to get the present value. Then the total will be the offer price. So we take sales, deduct cash expenses, deduct interest charges. I skipped the capital allowances. There is the capital allowances, capital allowances, 30, 45, 60. 30, 45, 60. 30, 45, 60. Those are allowances which ought to be deducted. Okay, we are deducting that. Then give me the total here. Year one, 75 million. This is taxable profit. Year two, someone says 120 million. 120 million. Third year, 135,000. 135 million. Then we tax. The tax is 30%. 30% tax. 30% of 75, 30% of 120. How much is it? Year one, tax year one, 22,500. 22,500. Year two, Lucy K, 36,000. 36 million. Deduct the tax. Year three, 4,500. 4,500. Right? 4,500. Now give me the difference. Deduct the tax from the taxable profit. That would give us the profit after tax. Year one, 52,500. 52,500. Profit after tax. 52,500. Year two, 84,000. 84,000. Third year, 94,500. 94,500. That is the profit after tax. Profit after tax. We then add back the capital allowances. Add back capital allowances. Add back the capital allowances. 30, 45, 60. Add back the capital allowances. 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 Add back. Then there is also the cash flows to replace assets. Cash flows to replace assets ought to be deducted. Cash flows to replace assets. Year one, 37,500. 45,000. 52, 500. 52,500. The cash flows to do what? The cash flows to replace assets and finance growth So these are outflows. So you deduct. What you get here is what we are looking for. So what will the net cash flows year one? Net cash flows year one. Net cash flows year one. Net cash flow year one. Kabasha, net cash flow year one. Net cash flow year one. Someone says 45 million. $45 million. Next, 84 million. The third year, what will be the net cash flows third year? 102 million. So these are the net cash flows which we are required to discount. Year one is 45 million. Year two, 84 million. Year three, 103 million. About the discounting factor, year one is just 1 over 1 point. The discounting rate, we have it 1 point. Is it 1.1? 0913. This is the factor raised to 1. Year 2 will be 1 over 1.10913 raised to 2. Year 3, 1 over 1.10913 raised to 3. Factors. Year 3, someone sells 102. This is 102, not 103. So what are the factors? Discounting factors. Discount. The discounting factors. Year 1. Year 3 is 102. But I had written 102,000. Justice says 0.9016. 0.9016 is a discounting rate. Year 2, discounting factor 0.8129. 0.8129, that's Kevin's answer. Year 3, 0.7329. 7329. Then discount. Multiply the cash flows, the future cash flows, by the discounting rate to get the present value. Year 1, how much is it? Year 1, don't round off. These are millions. Don't round off. 40,572. 40,572. Correct? 40,572. Year 2, 68,283. 68,283. 68,283. 68,283. 600. 68,283. Is that the position, or is it 0.6? Is it 600 or 0.6? Cannot be 600 because there are 3 zeros here. 68,283.6. Yes, Kabasha, that is true. Then the third year, Agostino says 74,755. 74,755 point something. 0.8. 0.8. 0.8. So these are three cash flows. Can we proceed? Yes. Now, we need to calculate the cash flows from year 4 to perpetuity. From year 4 to perpetuity. Look at the additional information number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year into perpetuity, in perpetuity. Now tell me now, what will be the cash flows here? What will be the discounting factor? And what will be the present value? That is your assignment. Give me the cash flows. That is your assignment, class assignment. You do it now. Give me the figure, please. Let me hear from each and every one. What will be the cash flows, future cash flows from year 4 to perpetuity? What do you think is the cash flows from year 4 to perpetuity? That's what we read in note number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4%. From our working, we calculated the net cash flows from year 1 to year 3. Someone, please, help me with the cash flows from year 4 to perpetuity. I needed the cash flows first. This cash flow. This one. And you are right, it is straightforward. Think you are right, Justice. It is straightforward. It is straightforward because this is what we need to write there. 102. It is straightforward. Okay? It is straightforward. But I've seen you've gone ahead to give us the present value annuity factor. You've gone ahead. Multiply, Hope says, multiply the CDS by 104. Multiply the CDS by 104. Now, I needed you to try that way. Multiply the CDS by 104. I think you are adding 100%. You are adding 4% to 100% to get 104%. All right. I needed you to try that way. Now, candidates, look at the question. It says, if Duet Limited acquires, the expected results from the cash flows will be as follows. We've seen the cash flows and the expenses. These are the cash flows, the sales and the expenses, and we have computed the net cash flows. At the end, after year 1, after year 2, that is the net cash flows. After year 3, we have the 102 million. This 102 million, the 102 million is what we are informed in note number 1, that is expected to grow or to increase by 4%. This 102 million, it is after the 3rd year. We are talking about 4th year, from 4th year, because these cash flows are at the end of the years. This is 45 million at the end of year 1, 84 million at the end of year 2, 102 million at the end of year 3. at the end of year 3 is the beginning of year 4. So we read here that from the 4th year, from year 4, from the 4th year onwards, it is expected that the annual cash flows from small limited will increase by 4%. So it is this 102 million from the beginning of year 4 that is going to increase at the rate of 4% into perpetuity. Now, in perpetuity means at the end of year 5, it will also grow at 4%. At the end of year 6, it will grow at 4%. At the end of year 7, it will grow at 4%. At the end of year 8, 4%. At the end of year 9, 4%. At the end of the 10th year, so we can go on and on into perpetuity, okay, continuously. So we need to calculate that amount, which we need to have it here, then we discount it. And to calculate that, we need to use this formula, P naught. The value of these cash flows will be equal to D naught. We are just using D naught, but you can use anything else, okay? It's D naught. Then we grow it at the rate of 4%. That will be into 1 plus the growth rate. Then we divide the rate cost minus the growth rate. This is the formula you covered in financial management. You recall when computing the value of cash flows that are running into perpetuity. This is the formula we use. If you are studying advanced financial management, this formula you used it and you passed the exam. That's why you are doing this paper. There was a question that was tested in your financial management paper which you passed. And this is the formula that you use to calculate the value of cash flows that are expected to be received into perpetuity. So this D naught is the present amount of 102 million. We grow it. The growth rate is 4%. 1 plus growth rate of 4%. 4% converting to decimal is 0.04. So it will be 1.04. Then we divide it by the rate. Okay, the discounting rate. I think we had it here. That is 0.01. No, not 1, but 0.1. 0.10913 minus the growth rate 0.04. That will be the amount we need to insert at that point. Is that clear? Yes, Agostino, you had a point. A over R minus G. That is correct. So what is the cash flows? Someone says 1534. 1534 500. 1534 500. 1534 500. 1534 500 0.217. 0.217. So the factor here, discounting factor, this is 4 years, will be 1 over 1.1093 raised to 4. That will be the discounting factor. Raise it to 4. Raise it to 4. So what is the discounting factor? 0.66. Kevin says 0.6689. 0.6689. present value, multiply that with that, give me the present value 6608. 6608. Present value. Present value. What's the present value? What's the present value? What's the present value? What's the present value? What is the present value? 10, 13. 10, 13. 10, 13, 997, 997 point something. Point 743. 0.743. Then the offer price. What is now the offer price? Get the total present values. We'll have the offer price, and that will be the answer. The offer price. This the offer price. The offer price. Total will be the offer price. 1197. 1197. Someone says 1197. 1197 609 point something. 609 point 143. Point 143. That is the offer price. That is the offer price. These are how many marks? 8 marks. 8 marks. These are calculated values. Calculated values. Calculated values. All this just for 8 marks. Just to earn you 8 marks. 8 marks. Those are workings. You earn marks for correct entries. That is not to say that you should not show your workings. Your workings have to be shown. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Okay, 13 entries. 13 correct entries will earn you the 8 marks. Do you see why I said this paper was, the question was easier? Easy in terms of it will take you a short time to calculate. All these values are derived directly from the question. These ones you pick directly from the question. The only tricky bit that students maybe found a challenge, those who answered this question, was at this point. That was the tricky part. This point. Another trickiest part is this point. If you do not get the cost of capital correct, then all these values will be wrong. A student who didn't get the right weighted average cost of capital, then there is no way this would be correct. Okay, all these marks will be lost, including this. See, we have used it here to calculate that. You've used this to calculate this. Are you following? And you need to be very keen, and that's how the examiner tests papers. If you fail to get the right cost of capital here, then chances are, when answering this question, maybe the only answers that are not affected by this rate is this entry, and that entry. Just 3 entries. Do you understand? Any question? We are through with that question. Do you have any question? I think that last value is wrong. Which one? Which one? Which value is wrong? And you are the one who gave us the value. Which one? The last value? Justice, which value? Perpetuity? For year 4 to perpetuity. 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 He says this value is not correct. How did you arrive at this value? That is a formula. Can you please confirm? Can someone else confirm? You have to grow it. This one is growing at 4%. Any other question? Please take time, go through the questions that are related to this one in the past papers. If you come across any question that you are unable to solve, we can solve it together here on the board, but continue revising. You have enough time. Revise the past papers. Bye. Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, you are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1, describe 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings? Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate, in carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because you know, candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. Inspection of buildings documentation. You understand? That is, if the building was bought, then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings, whether the buildings were bought or even constructed by the company. There are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The fourth audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses of for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector, and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? And what are the standards? What are the norms in the industry compared to what the company is doing? Because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. Communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with third parties. Industry experts. So these are some of the audit procedures. They are not the only audit procedures. There are more. There could be more, but these are 6 audit procedures that the auditor can perform in relation to the buildings of Miradi Limited Company, which has not been providing for depreciation on buildings for the last 3 years. So the auditor here, I'm saying, should seek validation or additional insights to support audit findings. So these additional procedures candidates aim to enhance the auditor's understanding of the depreciation matter. These audit procedures may also help the auditor assess the impact of the decision not to provide for depreciation on the financial statements, and also to ensure compliance with accounting standards and regulatory requirements. That is the solution to that part. Additional audit procedures: number 1, review accounting policies. Number 2, assessment of depreciation methodology. Number 3, inspection of buildings documentation. Number 4, evaluation of maintenance expenditures. Number 5, a comparison with industry standards. Then lastly, communication with third parties. That is part A, Roman 1. A, Roman 2, assume that according to your workings, the depreciation charge on buildings for the year ended 30th June 2023 should be 4.2 million based on the straight line method of depreciation at an annual rate of 5%. Required, discuss the implications of the above on the financial statements, clearly indicating its effect on the audit report. This is Roman 2. We have to discuss implications of the above on the financial statements. The above is assuming, according to your workings, the depreciation charge on the buildings for the year ended 30 June 2023 should be 4.2 million on the straight line method depreciation at an annual rate of 5%. What is the implication of this? What is the implication if the depreciation was to be 4.2 million? What is the implication on the financial statements? This question is in 2 parts. Implication on the financial statements, then clearly indicating its effect on the audit report. We'll also discuss the effect of this information on the audit report. But first of all, let us discuss implications on the financial statements. Failure to provide for depreciation on buildings, despite being required by accounting standards candidates, has several implications on the financial statements and consequently on the audit report. So what are these implications on the financial statement. The first implication is overstatement of assets. Overstatement of assets. Now, since depreciation represents the systematic allocation of the cost of an asset over its useful life, not recognizing depreciation results in overstatement of the carrying amount of buildings on the balance sheet. And in that case, the building's value would remain at their original acquisition cost, leading to an inflated asset value. So ideally, depreciation is to reduce the cost of the building. But if depreciation is not charged, then the assets will be overstated. The asset will be overstated. We read from this question that the company has a net asset of 150 million. This is a total value of assets. That tells you that the value of 150 million is overstated because of the fact that the company does not provide for depreciation. And if this company has not been providing for depreciation for the last 3 years, and we have read in note number 2 that the depreciation charge, the auditor may have carried out this depreciation to be 4.2 per annum. If the depreciation charge is 4.2 per annum, and this company has not provided for depreciation for the last 3 years, you can see, candidates, the depreciation charge, the accumulated depreciation is 12.6 million. So that means that the total value of assets, the net assets of 150 million is overstated by 12.6 million. That is the implication of not providing for depreciation on assets by this company. That's the first implication. The second implication is the overstatement of net income. The net income is overstated as well, because depreciation expense is deducted from revenue to calculate net income. And by not recognizing depreciation, the company's reported net income would be higher than it should be. And in this scenario, the absence of depreciation charge of 4.2 million would lead to the overstatement of net income, thereby distorting the profitability of the company. So for example, if the company recorded net profit for this year of say 30 million, that means that net profit is overstated by 4.2 million. So that is the impact of not providing for depreciation on buildings. Number 3, distorted financial ratios. Distorted financial ratios. Now, the overstatement of assets and net income due to the omission of depreciation affects various financial ratios. For example, the return on assets ratio would be inflated, giving a false impression of the company's efficiency in generating profits from assets. Similarly, the debt to equity ratio could also be affected, as the inflated assets would lead to a lower leverage ratio. You may have other assets like the return on capital or return on capital employed, which is calculated by getting the ratio between the net profit and sales, or net profit and return on capital employed. So the omission to depreciate buildings could lead to distorted financial ratios. Why? Because the assets are inflated, net income is also inflated, and that could affect various financial ratios. That is an implication of not providing for depreciation on buildings. for misrepresentation of the financial position of the company, of the financial position of the company. Misrepresentation of the financial position of the company. Financial statements are meant to provide a true and fair view of a company's financial position. So failing to recognize depreciation results in misrepresentation of the company's true financial position by overstating assets and overstating profitability. And these misrepresentation candidates could mislead stakeholders, including investors, creditors, and even the regulators. So that is the fourth impact for not providing for depreciation on buildings. The question required candidates also to highlight the effect of this omission on the audit report. If I can take the question again, discuss the implications of the above on the financial statements. So these are the impacts on the financial statements, clearly indicating its impact on the audit report. Impact on audit report. What is the impact of this omission on audit report? Impact on audit report. Now, the auditor would need to issue a qualified or adverse opinion. The auditor may need to issue a qualified or adverse opinion. As a result of these effects of omission of depreciation of buildings on buildings, as a result of these effects or this omission of depreciating buildings has effect or impact on the audit report. One impact is that may lead to issuance of a qualified or adverse opinion. And that whether the auditor issues a qualified or adverse opinion depends on the materiality or the pervasiveness of the issue. And candidates here, a qualified opinion would be issued if the auditor concludes that the failure to recognize depreciation results in a material misstatement of the financial statements, but is not pervasive. On the other hand, an adverse opinion would be warranted if the auditor determines that the misstatement is both material and pervasive, meaning that it affects multiple areas of the financial statements. So that would be one impact. That may lead to issuance of a qualified opinion or adverse opinion depending on the materiality of and pervasiveness of the error. The audit report number 2 may also include a section discussing the basis for qualification or adverse opinion. There would be an additional paragraph. The audit report would contain a section. You understand? Discussing the basis for qualification or for issuing an adverse opinion. And this section would explain the reasons for the auditor's conclusion, including the failure to recognize depreciation, including the impacts of this omission to depreciate buildings on the financial statements. It would also highlight the departure from accounting standards and regulatory requirements. Additional paragraph. There will be a section explaining the impact of this mistake on the and so on. So these are two impacts on the audit report. Now, candidates, in concluding this part of the question, we can say that the failure to recognize depreciation on building has significant implications for accuracy and reliability of the financial statements, requiring appropriate disclosure and also qualification in the audit report in order to inform the stakeholders of the limitations of the financial information that has been presented. So the auditor has a duty to inform the users of the financial statements of the failure by the management to depreciate buildings. Failure to recognize depreciation on buildings has significant implications for the accuracy and reliability of the financial statements. You've seen how the failure of this failure can lead to implication on the assets. It has implications on the net income. It has implications on financial ratios. It has also implication on the truthfulness and the fairness of the financial statements, because we know that financial statements are expected to portray a true and fair view. But if there is an omission in depreciation, that can lead to misrepresentation of the financial position, which means that the financial position of the company as presented by the management does not present a true and fair view. So that is question A, but two had 8 marks. 1, 2, 3, 4, 5, 6. Any 4 points there would earn you 8 marks. Part B, audit risks associated with audit of financial statements. Now, candidates, financial instruments, we all know, present unique challenges for auditors due to their complexity and due to their inherent risks. So what are some of the audit risks that are associated with the audit of financial statements? So if you are to audit financial statements, what are some of the risks that are associated with audit of the financial instruments? Not statements, but instruments. Audit risks associated with audit of financial instruments. The first audit risk is the valuation risk. Valuation risk. Now, financial instruments are often valued using their fair value estimates, which can be subjective and prone to error. So auditors need to assess the appropriateness of valuation techniques, and the auditors also may need to assess the underlying assumptions used by the management. So when auditing financial instruments, the auditors must pay attention to the appropriateness of the valuation techniques and also the underlying assumptions that were used by the management to value the financial instruments. So valuation risk is an audit risk associated with the audit of financial instruments. 2, model risk. Model risk. Now, complex valuation models are sometimes used to determine fair value. And these models can be flawed or can contain errors leading to misstated financial instruments or even misstated financial statements. So auditors need to evaluate the control around model development and their use. So financial instruments are valued based on certain models. So there could also be errors in the development of these models, which can pose model risks. And when auditing these financial instruments, the auditors ought to pay attention to the models and the risks and how they are developed. There are also inherent risks associated with the audit of financial instruments. Number 3, inherent risks. Financial instruments are inherently risky due to factors like market fluctuations, factors like creditworthiness of the counterparts, and also liquidity issues. So the inherent risk associated with the specific instrument can be high, requiring extensive audit procedures. Inherent risks. 4, control risks. There are also control risks associated with the audit of financial instruments. The internal controls surrounding financial instruments may be weak, they may be ineffective, and that could allow for errors or fraud to go undetected. So auditors need to assess the design and also the operating effectiveness of controls related to financial instruments and also related to transactions around financial instruments and valuation. Control risks. Lastly, we have classification risk. There's also risk associated with classification. Financial instruments can be complex and may be incorrectly classified in the financial statements. And this misclassification can have a significant impact on the reported financial position and results. So auditors need to understand the classification criteria, and also they need to test the company's classification processes. Classification risks. There's also disclosure risk associated with the audit of financial instruments. Disclosure risk. The financial statements may not adequately disclose the nature and the extent of the risk associated with financial instruments. And insufficient disclosures candidates can mislead users of the financial statements. So auditors need to assess the completeness and the accuracy of disclosures related to financial instruments, like derivatives. So these are 6 audit risks. Candidates were to give 6 audit risks. 1 is valuation risk, 2, model risk, 3, inherent risk, 4, control risk, 5, classification risk, 6, disclosure risk. How many marks? These are 6 marks. 6 marks. Part A of the question, how many marks? This one, 6, this a point here, 6 marks. Then we have 6 part 2, implication on financial statements, 6 marks. These are 8 marks. Any 4 points will earn you 8 marks here. Total is 20 marks. So that is a suggested solution to the Advanced Auditing and Assurance December 2022 question 1. Thank you for attending the lesson. In our next session, we are going to answer question number 2. So please attempt question number 2 before joining our next session. Bye-bye. Greetings to you all and welcome to the revision session of the financial accounting paper that was done by CPA and CFA candidates on Monday, 4th of April 2022. This was a morning paper. The candidates were expected to answer 5 questions in a time period of 3 hours. And in this session, I'll be tackling a question at a time. In this first session, I'll answer question number 1. In the next session, I'll answer question number 2 until we complete the 5 questions. It's my hope that you are ready to revise. I also hope that you attended the class lectures where we took you through all the topics as per the 2021 Kasneb revised syllabus. Welcome to the lesson. Question 1 of the financial accounting paper that was done in April 2022 reads as follows. Part A, highlight 5 elements of financial statements, 5 marks. I'll first answer that one. Elements of financial statements. So candidates, what are financial statements? Financial statements are also known as the final accounts, and the main financial statements are the statement of income, or what we call the trading profit of something. An element is a section. The candidate required, the examiner required candidates to highlight 5 elements of financial statements. 5 elements of financial statements. This is financial accounting. We are revising the paper that was done in April 2022. Question number 1. A, elements of financial statements. I've said the main financial statements are the income statement and the balance sheet. So what are the sections in a statement that is known as the profit and loss account, the trading profit and loss account? So if you are to look at an income statement or a statement of financial position, you'll find elements like revenues. And in a short while, we are going to be preparing a statement of profit and loss account. When preparing a statement of profit and loss account, which is a financial statement, the first section, the first element, the first segment is revenues. The second element in a statement of profit and loss account is what we call expenses. So these are the main elements in a statement of profit or loss account. Then the main elements in a statement of financial position, the main elements, we have assets. We have number 4, liabilities. Number 5, what we call equity. So these are the main elements of financial statements. Revenues, Now, what are revenues? Revenues are increases in assets or decreases in liabilities. What are expenses? Expenses are decreases in assets or increases in liabilities. When liabilities increase, then that is as a result of the expenses. Then there is assets. What are assets? Assets, or an asset, is a present economic resource that is controlled by an entity as a result of past events. What are liabilities? Liabilities, or a liability, is a present obligation of the entity to transfer an economic resource as a result of past events. How about equity? Equity learners, is the residue interest in the asset of an entity after deducting all its liabilities. We know from the balance sheet equation that assets equal liabilities and equity. So if you are to make equity the subject of that formula, then equity will be equal to assets minus liabilities. So these are the main elements of financial statements. Example of revenues are things like sales, right? Revenues are items like discount received, commissions, and so on. Expenses are like airtime, telephone expenses, transport expenses, insurance expenses. You can name them, all right? Assets are like land. Land is an asset. Buildings are assets, all right? Prepayments, prepaid expenses are assets. Inventories is an asset. Then liabilities, accounts payable. Loans, those are liabilities. Okay? Equity, we're talking about here, capital. Reserves. Premium, share premium, and so on. So this would earn you how many marks? 5 marks. Identifying the elements will earn 5 marks. 1, 2, 3, 4, 5 marks. Let's now move on to answer part B. I read, Fatuma Ali commenced business as a retail chemist. Fatuma Ali commenced business as a retail chemist on 1st January 2021 with an initial capital of 30 million shillings, which she paid into her business bank account. She hired a shop manager at an annual salary of 2 million shillings. In addition, the shop manager is to receive a commission of 10% of the gross profit. During the year ended 31st December 2021, Fatuma Ali did not maintain proper books of account. After an examination of the available records, the following information was extracted. The bank statement for the year ended 31st December is as follows. We have the receipts and the payments. Then below the bank statement, additional information number 1, I read, all sales were for cash and sales are banked. All sales were for what? Were for cash, and sales are banked daily, subject to the retention of a cash float of 100,000 shillings. The following payments are made out of cash sales. We have the manager's salary, drawings, payments to suppliers, general expenses. Note number 2, I read, as at 31st December 2021, checks sent to suppliers amounted to 2.5 million had been presented to the bank for payment. Number 3, as at 31st December 2021, invoices from suppliers amounting to 8.6 million had not been paid. Number 4, as at 31st December 2021, inventory was valued at 36.5 million shillings. Number 5, depreciation per annum is to be provided on motor vehicle at the rate of 25% on cost and on the shop fittings and equipment at 10% on cost. Note 6, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 shillings for her personal use. Required 1, statement of profit or loss for the year ended 31st December 2021. How many marks? 8 marks. 2, Statement of financial position as at 31st December 2021. How many marks? 7 marks. 7 marks. This is part B. Statement of profit or loss. The name of the business? Fatuma Ali. Fatuma Ali. Fatuma Ali. Fatuma Ali. We are preparing statement of profit or loss as at what? For the year ended. The period is 31st December 2021. 31st December 2021. This is a statement of profit or loss. And in part A, we said that the elements of a profit or loss include revenues. So we're going to begin here with the revenues. The revenues are in millions. Fatuma Ali revenues. So the first revenue here is the sales. Sales. For us to calculate sales, we need a working because the sales are not provided clearly in the question. Why? Because Fatuma Ali did not maintain proper books of accounts. If Fatuma Ali prepared proper books of account, then these sales we need to pick it from the trial balance. But here there is no trial balance, therefore we are going to use the information provided to determine the sales. So working number 1 will have sales. Working 1. And from the receipts, from the bank statement, we can see we have sales amounting to 123,720 shillings. In addition, information number 1, we read that all sales were for cash and sales are banked daily. All sales are what? Were for cash. That means the customers were not allowed to pay by check. It was just by cash. And sales were banked daily, subject to retention of 100,000 shillings float. So the payments that were made out of cash sales, we have manager's salary, drawings, payments to suppliers, and general expenses. That means that when Fatuma Ali received cash from the customers, that cash was used to make cash transactions, and they are listed. So when preparing the sales account, these are the items to include in the sales account. Working 1, these are workings. 1 sales account. Sales account working 1. Now in note number 1, candidates, we read that all sales were for cash and sales are banked daily, subject to retention of a cash float of 100,000 shillings. So all sales were for cash. What does that mean? That means that Fatuma Ali sold on cash basis. The customers paid in cash, and all the cash was banked. So if we check the bank statement, you can see the second item on the debit side of the bank statement reads sales 123,720. So that's the first item to recommend to record in this account. Bank 123,720. So out of the cash that was received, 123,720,000 was banked. But we read in note number 1 that not all the cash that was received was banked. Part of that money was spent, and we've given the items here. So we're going to prepare another account, which I'll call cash account. The cash account, because some of the sales that were received were paid out of cash. And the first item there is manager's salary. The manager's salary was paid out of cash, because when you pay salaries, you credit the cash account and debit the salaries account. So here we have 1.98 million. 1.98 million. The second item, drawings, 4 million. The third item, payment to suppliers. Suppliers were paid how much? 1390. General expenses. General expenses amounting to 840 was also paid from cash. Then there is also the float. Retention of 100,000. Float of 100,000. So these are the payments that were made out of the cash sales. So I'm going to have the total 1980 plus 4 million plus 1390 plus 840 plus 100 is 100, which gives me here 8,310,000. 8,310,000. So the balancing figure, we need to balance this account by transferring all these amounts, which is a total of 8,310,000. This amount we transfer to the sales account. Sales account. So this amount is transferred from cash account to the sales account. So we record here cash 8310. 8310. So these two will constitute the sales for the year. So there are sales that were banked and sales that the amounts that were used to pay these expenses, 8,310,000. I'm going to get the total 123,720. The amount that will be transferred to the statement of profit and loss is 132,030. 132,030. 132,030 is the figure for sales, working number 1. 132,030,000. 132,030,000. That is sales for the accounting period ending 31st December 2021. So what is the cost of these sales? Cost of sales. We read from this question that Fatuma Ali commenced business as a retail chemist on 1st January 2021. That automatically tells you that Fatuma Ali did not have opening inventory, because it's only been in operation for 1 year. So there is no opening inventory, but we have purchases. Purchases. Again, purchases are not provided directly from the question, because the businesswoman did not maintain proper books of accounts, because if proper books of account was prepared, then we could simply pick the purchases from the trial balance. Therefore, we must have a working for purchases. Purchases account. This is working number 2. Purchases account. We'll go through the question and identify all the items that are to be effected or to be transferred to the purchases account. And I want you to look at the bank statement first of all. The bank statement, we have payment to suppliers of 112,360,000. Payment to suppliers. You can see the bank statement is credited. Therefore, the purchases account will be debited with the bank. The amount there is payment to suppliers 112,360. Then additional information. We read in note number 2 that as at 31st December, checks sent to suppliers amounting to 2.5 million had not been presented to the bank. So suppliers were paid there. We have checks amounting to 2.5 million. 2.5 million. Those are checks. Note number 2. In note number 3, as at 31st December, invoices from suppliers amounting to 8.6 had not been paid. So these are invoices. Invoices amounting to 860. This is 8.6 million. 8.6 million had not been paid, so we debit the purchases account with 8.6 million. Then depreciation. Note number 6, we read, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 for her personal use. That is an amount that we'll have to have it here as drawings. Drawings, we'll have drawings there. Then we see in note number 1, payment to suppliers. That is payment to suppliers, cash payment to suppliers. Out of the sales that were received, suppliers were paid. As we saw here, suppliers were paid. These are purchases, 1390. So these are the items that will enable us determine the purchases for the year. Purchases for the year. We are going to get the aggregate. Aggregate. We add 1,2,360 plus 2.5 plus 86 plus 1390. The total 124,850. So this is what will be transferred to the statement of profit or loss. 124,850. 124,850. 124,850 is the value for purchases. 8. This is 124. 124,850. 124,850. Then there is the drawings of that is the last note. During the year, Fatuma Ali took goods which cost 100,000 for her personal use. These are drawings of 100,000 shillings. Drawings 100,000 shillings. The drawings reduce the reduction in the goods that are available. Then do you have closing inventory? Closing inventory. The closing inventory note number 4 was valued at 36.5 million. Closing inventory. Closing inventory note number 4, 36.5 0.5 million. So that will be the cost of sales. We're going to add 124,850 minus 100 minus 36.5. Cost of sales 88,250. Deduct cost of sales from sales of 132,030. The gross profit 43,780,000. This is the gross profit. I hope you are also confirming, candidates, the figures, the gross profit. Are you arriving at 43,780,000? Yes. Then the second element in the statement of profit or loss is what we call expenses. What are the expenses? We again run through the question, identify the expenses. First of all, let's look at the bank statement. Are there expenses from the bank statement? Yes, we have interest on bank loan. Interest is an expense. Interest is an expense, 1 million. Then there is the general expenses. General expenses will have a working for general expenses. Why? Because general expenses were paid through the bank. Then there were also that were paid out of cash. General expenses were paid out of cash. General expenses will be equal to the amounts that were paid through the bank of 83.35. So we have 83.35 plus the amounts that were paid from cash note number 1, general expenses 840. These two will give the total value for general expenses, 83.5 plus 840. General expenses 91.75. 91.75. That's the value for general expenses. Then from the bank statement, rent was paid. Rent is an expense. Rent is an expense, 37.50. 37.50 is the value for rent. Now let's check from additional information. Do we have any expense? Manager's salary. Manager's salary is an expense. Manager's salary, that is an expense. Manager's salary is an expense. And you recall, candidates, that in sentence 2 of the question, that Fatuma Ali hired a shop manager at an annual salary of 2 million. In addition, the shop manager is to receive a commission of 10% of the gross profit. And from the trial balance, I mean from the bank statement, there is no payment for the manager's salary, neither the commission. But in note number 1, you can see that the manager was paid 1,980,000, meaning that this manager, there is salary owing. The business owes the manager some amount, because the amount ought to be 2 million. But for the purposes of preparing the statement of profit or loss account, we need to indicate the total value, whether the money was paid or not. So the manager is paid 2 million. Are you clear on that? 2 million. That means that out of this 2 million, only 1,980,000 was paid, but 20,000 is due. That's outstanding manager salary. Then below here, we need to indicate the commission. This manager, we read, is also paid commission of 10% on gross profit. So 10% of gross profit, the gross profit 43,780. 10% of 43,780 is equal to 43,78. So 10% of 43,780,000 is equal to 4,378. That is the commission. Is there any other expense? Yes. Look at note number 5. Depreciation per annum is to be provided on motor vehicle at the rate of 25%. Depreciation is an expense. Depreciation. This depreciation should be, the rate should be applied on motor vehicle, one motor vehicle. The rate for motor vehicle is 25% on cost. So this is 25% times the cost. The cost is to be found in the bank statement. That is item number 3 on the credit side of the bank statement, motor vehicle 2740. 2742,740. So 25% of that is 2740, which is equal to 685,000. That is depreciation, motor vehicle depreciation. Another asset that is depreciated is fixtures and equipment. Fixtures and equipment is to be depreciated at the rate of 10% on the cost. So let's identify the cost of fittings and equipment. Fittings and equipment is the second item on the bank statement. That is 8,800,000. 8,800,000. 10% of 8,800,000 is 880,000. So, candidates, what else do we have here? Going through the question again, I don't see any other expense. We have salaries. That is manager's salary. We've identified it and recorded it. These are the only expenses. So we're going to get the total expenditure, then deduct from the gross profit. Total expenditure 1 million plus 9175 plus 3750 plus 2 million plus 4378 plus 685 plus 880. Total expenditure 21,868, deduct from gross profit of 43,780 is equal to 21,912. That's the net profit. Net profit. Net profit. 21,912,000. We've answered part B. Let's answer part C. That is part. This is B1. Then B2. The statement of financial position for Fatuma Ali. Fatuma Ali. Statement of financial position as at 31st December. Statement of financial position. What are the elements of a statement of financial position? Assets, the first element. We're going to record the non-current assets first. Non-current assets. So we're going to have here the cost, net book value, the depreciation, and the cost in thousands. The first asset is leasehold premises. Leasehold premises, 20 million, zero depreciation, 20 million book value. The next one is fittings and equipment. Fittings and equipment, cost 8.8 million. Depreciation on fittings, these are fittings and equipment depreciation, 880. 880. Net book value is a difference between the cost and the depreciation, 800 minus 880. Net book value 7920. Motor vehicle, cost of motor vehicle 2740. Depreciation on motor vehicle is 685. Net book value is the difference between the cost and the accumulated depreciation. The difference 2740 minus 685, and net book value 2,055,000. These are the non-current assets. Going to total here and close, total there and close, total but don't close. Then we move on to the current assets. Current assets. The first current asset here is inventory. Closing inventory, note number 4, 36.5 million. 36.5 million. The next one is bank, that is a balance carried forward, that is balance carried forward or balance carried down, 16,735. 16,735. What else? I draw attention to note number 1. All sales were for cash and sales are bank daily subject to retention of a cash float. So that is a cash, which is a current asset, 100,000. So we get the total. We'll add to the non-current assets. I'm moving on to calculate the liabilities. This will give us the total assets. Let me get the total assets. Total assets, I'm adding here the net book values, 20 million plus 7920 plus 2055, 29,975. Going to add the current assets, 36.5 million, 36.5 million plus 167.35 plus 100, 53,335. Total assets plus 29,975. Total assets 83,310. So these total assets are financed by, first of all, we have capital from the First statement, we read that Fatuma Ali commenced business with the initial capital of 30 million. So capital here, 30 million. Then there is, we add the net profit for the year, 21,912,000, 21,912,000, 21,912,000, and then before I get the total here, I'm going to deduct the drawings. Drawings from the cash account, we saw that Fatuma Ali withdrew 4 million. 4 million, that is from cash. When you check the last additional information, we read that Ali took goods. Fatuma Ali took goods worth 100,000. These are drawings in form of goods. So we add to the cash, giving a total of 4.1 million. This we deduct. Drawings reduce the capital. So we are going to add the 30 million plus profit 21,912 minus 4.1. So here we have capital of 47,812. Then these total assets were also financed by non-current liabilities. Non-current liabilities. We have one non-current liability known as bank loan. The loan is a non-current liability because Fatuma Ali is expected to repay this loan for a period of more than 12 months. So there is a bank loan on the debit side of the bank statement, 20 million. 20 million. We are going to add current liabilities. Current liabilities. The first current liability is accounts payable. Accounts payable. Candidates, accounts payable, you can see in note number 2, checks sent to suppliers amounted to 2.5. Had not been presented to the bank. Okay? 2.5. Then in note number 1, we read that payments were made to suppliers. So we have we are going to add, as at 31st December 2021, checks sent to suppliers amounted to 2.5 had not been presented to the bank. That means that these suppliers had not been paid, because for the suppliers to be paid, the checks must be presented to the bank. They must be presented to the bank. That means the amount was not deducted from Fatuma Ali's account. So that still remains a liability. But in note number 1, we have those suppliers that were paid. 1.39 million was paid from cash, and therefore the accounts payable will be equal to 2.5 million plus note number 3, invoices from suppliers amounting to 8.6 had not been paid. These are invoices to suppliers that had not been paid. Suppliers had supplied the goods, but they had not been paid. So if they had not been paid, then that's a liability, 8.6 million, 8,600. So you're going to add 2.5, 2,500 plus 86. So total current liability for this account payable 11,100,000. Then another item here under current liabilities, remember the manager's salary. The manager's salary. The manager salary is 2 million per year. From the bank statement, we read that the manager was only paid, that is from the cash, manager was only paid 1,980,000, meaning that there is accrued salary. Or let me write salary due, the same thing, or salary outstanding, outstanding salary, salary, manager's salary due, salary due 20 million. The manager was expected to be paid 2 million, but he was only paid 1,980,000, meaning 20,000 is due. Then from the records provided, there is no account where the manager's commission is to be paid. We read that the shop manager is to receive a commission of 10% of the gross profit. From the bank statement and the cash payment, no commission was paid. So therefore, that commission is also a liability. Commission due, we had calculated the commission due here, 4378. 4378. So these are the liabilities. We have the long-term liability, 20 million. Then the short-term liabilities, I'm going to add the short-term liabilities, 111,000 plus 20 plus 4378, 15,49,8 plus 20 million plus 47,812. So I'm getting here 83,310,000. This is total equity or capital and liabilities. The total equity total equity plus liabilities should always be equal to the total assets. You can see here the total assets 83,310,000, 83,310,000. So that marks the end of the question. We've done part A of the question, 5 marks. Part B, Roman 1 of the question, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. All these marks give a total of 8 marks, or the ticks will earn 8 marks. Then we have the net book values here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. The 16 ticks will earn you 8 marks. These are they 8? These are 7 marks. 7 marks. So, learners, this is a question that tested the candidate's knowledge in preparation of the financial statements from incomplete records. Fatuma Ali did not prepare complete records, did not maintain proper books of accounts. So I want you to expose yourself to various scenarios of improper records. This question can come in various ways. We covered this one in the normal video lectures. We have done several past paper questions in relation to preparation of statement of financial position based on incomplete records or improper books of accounts. And if you have any question, please feel free to send it. Below this video, there is a comment section where you can post your questions, and all your questions will be answered. In our next session, we're going to answer question number 3. I urge you to go through question number 3, attempt it. It's a question testing you on the area of not-for-profit making organizations. This is the financial statements of the organizations that whose objective is not to make profit. Thank you. God bless you. Bye-bye.
Publishers.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I am a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are discussing about business and data analytics, question 21, which came in the December 2022 exam. So question 21, we had answered it in our previous lesson, and just to recap what we discussed or what we solved, you are provided with the following extracts of the statement of profit and loss for Sepetuka Limited. So you can see the statement of profit and loss from years 2019 through to 2022 were provided. You are required to calculate and interpret the following ratios: the annual revenue growth rates for years 2020, 2021 and 2022, the 3 years cumulative growth average growth rate CAGR for year 2022, the effective tax rate for the period 2019 to 2022. Now, in part B, we were told to assume the following for Sepetuka Limited. The revenue growth rates are forecast under 3 scenarios, namely the base case, the optimistic case, and the pessimistic case right there. The base case growth rate for the first year forecast is the 2022 CAGR. This is expected to reduce by 2% annually until the last year, forecast subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. Gross profit margin for the first year of the forecast is the 3-year average for the period from year 2020 to 2022. This is expected to reduce by 2% annually until the last year, forecast subject to a minimum of 50%. Operating expense ratios are modeled as the 3-year averages for the period from 2020 to 2022. These are assumed to remain constant over the forecast period. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for the period 2020 to 2022. Finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate in year 2022 over the forecast period. Number 6, income tax expense is calculated as a historical effective tax rate. So let's move on over to Excel worksheet. And this was question 21, that solution that we had already solved. You can see right down over here, we've put question 21A. The average revenue growth rates for years 2020, 2021, and 2022 are displayed to you there. The CAGR is 21%. The effective tax rate for period 2019 to 2022 have been displayed to you on your screen. Now we move over to question 21B. Click that tab and you can see this on the right of your screen. I have the statement of profit and loss extract as the way it was given in the question. And you are required in part B, go down over here, to prepare 5-year forecast statements of profit and loss for Sepetuka Limited from year 2023 to year 2027. So you can see that I have got, I've replicated this extract of profit and loss, which is on the left of your screen, right over here on the right of your screen, right up to there. And what we need to do is that because you're creating forecasts for the years, I can come here and create or distinguish that these are forecasts. They are not actual values there. So what I can do is that a true analyst or accountant is supposed to put F or put E just after the year that you're trying to estimate or forecast on, F, so on and so forth like that. 2026. Then we can move on to the next one, 2027 there, like that. So as we move along down and populating these cells, we are going to make the relevant adjustments. And you can see we start off with the first adjustment, first information we've been given. So I'll highlight it so that we can distinguish what we've solved and what we haven't solved there. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year forecast is the 2022 CAGR. And we have already worked out the 2022 CAGR in this tab part A above. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case. So we are first of all beginning with the base case right over here. So we can just try and distinguish it over here, and then the optimistic case and the pessimistic case would be worked just down below over here. So let's begin by populating the revenues or the sales. We are informed that the growth rates are forecast under 3 scenarios, namely base, optimistic, pessimistic case. The base case growth rate for the first year forecast is the 2022 CAGR. So plus, we pick that revenue for 2022 multiplied by, open the brackets, 1 plus G. What is the growth rate? The CAGR, which you're going to pick from this tab right over here. So we just go there and pick the compound annual growth rate there, and we close the bracket there like that. Enter. And it picks the value of the forecasted sales. Now we are accountants, analysts. We need to ensure that there's consistency in terms of the commas. So we come over there and click this one over here. However, we are sophisticated enough to know that we just click Alt H. You can see where K is, it represents that comma over there, so we press K. And this whole subsection over here will be populated with commas there, the similar format there. So how about 2024? So this is expected, you can see right on the bottom on the left of your screen right here. This is expected to reduce by 2% annually until the last year of the forecast. We just pick plus that one over there, and then times, open the brackets, we pick 1 plus 1 plus. So you can take this value, open the brackets, 21% minus 2% gives us 19%. So 19% like that, and we close the brackets like that. 137 that. Then go over there plus this value. Remember, it's 19% up to a limit of what? Up to a constraint of 15%. We're still at 19%. So times, open the brackets, 1 plus, so we're at 19%, and so we go to 17%. So 17% like that, and we close the brackets like that. We enter 160. 2026, we do the same like that, times, open the brackets, 1 plus 15%. 15%. That, enter, and here we still enter the same value you can see, plus that value, times open the brackets, 1 plus 15%. 15%, close the brackets, we enter like that. That is what we get for the revenue. Remember, we still have to go through the pessimistic case and the optimistic case, but we move systematically, we finish off the base case extract. So what does it say for gross profit margin? You can see here, I've highlighted it in this peach color almost. Gross profit margin for the first year of the forecast is the 3-year average for the period from year 2020 to 2022. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 50%. So the first thing is to first of all understand what gross profit margin is. So gross profit margin, allow me to use caps, GPM is equals to, we write the formula right over here. So we come to insert next to home, then we put the equation there, fraction, come to this one here like that. Then we just drag this fraction right over here and say the gross profit margin is given as the gross profit divided by the sales. That's what you get as the gross profit margin. So if you'll allow me, we could be able to compute the gross profit margin from the years 2020 through to 2022. So I will do it right over here because it corresponds with 2020 to 2022 right over here. Copy, just put that down over there, like that, the years. And we are saying that the gross profit margin is gross profit over the sales over here. So since we don't have the gross profit, we can be able to, we actually have the gross profit. This gross profit over here, we have it over here. I can highlight these gross profits over here. And the sales, and these are the gross profits over there. So those two are what we need to get. So for year 2020, that plus gross profit, that value, we divide by the sales, because we're just following this formula, that value. What is the gross profit margin for 2020? 0.5. But we want it as a percentage. So we click percent there, 50%. We drag the formula moving towards the right, and we can see that the gross profit margin for the 3 years 50, 60%, and 60%. As per the statement right over here, the 3-year average for the period from year 2020 to 2022. So that is what is going to, so we need to get the average of this. So we click right over here, plus average. You can see it's actually given to you right here, average. So you click that, average of what? Average of the gross profit margins over there. And we close the bracket like that, and we do what? Press enter. Gives us 57%. So let's try and see whether the statement has actually been solved. So we say gross profit margin for the first year of forecast is the 3-year average from period 2020 to 2022. So we've picked the gross profits for 2020 to 2022. This is expected to reduce by 2% annually until the last year forecast, subject to a minimum of 50%. So the gross profit margin is the 3-year forecast. So we can, so that means the gross profit margin from the forecast of 2023 will be 57%. So we can put here 2023 will be 57%. So how do we get now the gross profit? You can see from the formula, we just multiply the gross profit, rather the sales down here, with the gross profit margin, which we've computed over here like that. So to get the gross profit, we get plus 57% times the sales, enter, 65,516. What are we told then? We expect this gross profit margin is expected to reduce, you can see here, to reduce by 2% annually until the last year forecast, subject to a minimum of 50%. So 2%. So ladies and gentlemen, for consistency purposes, we just try and ensure that the format is the same up to 2027 right there. So, and then we drag what? We drag the years as well towards the right. So dragging would be able to, now of course, because we've just dragged from 2023, it will just replicate the cells from 2023. But we come right over here and fill the series, it now changes it to 2027. So what are we saying? We are saying that now we want to estimate the gross profit, the gross profit margins. So this one is reducing, plus that minus 2%, like that, 55%. Then we come over here plus the previous value minus 2%, shift percent, pardon me, like that. And we are trying to ensure, because it doesn't have two decimal places, these others. So what we do is that I try and reduce the decimal places over here that we have. So first of all, I double click over here because the cell did not pick in two decimal places. I highlight format Peter like that, and then I format it like that. It will come to two decimal places over there. No decimal place, sorry. So from there, I now move on to 2026. The limiting factor is 50%. So it's reducing by 2% throughout until it reaches 50%. So this one, so plus that minus 2%, like that. We have 51% like that. And this one obviously will have to be 50% because that is what the limiting factor is. And comfortably can put 50% like that. So then, now that we have the gross profit margins over here, just like the way I had computed the gross profit is the sales times GPM. GPM is gross profit margin. So I can then comfortably come and drag my formula moving towards the right like that. Then what do we do? How do we get the cost of sales? The cost of sales is just this value minus that value there. So plus that value minus that value, we get 50. And remember, this value over here should be negative just for consistency, to be negative like that. So what we can do, we can put a negative over there, that, and it changes the value there, and do that. So we just put negative right there, and it also changes, pardon me for that. So what we do is that we just pick negative. We can say that this value is going to be our negative value over here. So in brackets over here, we put it like so, like so. Then we put negative, delete negative, it comes like that. So consistency as well, that you just put it like that. So we proceed then. You can be able just to drag the formula like that. Once you get the plus sign like that, you can see it's got to the plus sign, you just drag it, it will just come and fit in like that. But I can see that if we get to just come in and double check over here, we can check and see, maybe even right over here, plus that value plus that one gives us what? 65. So moving it on towards the right like that, we should be able to get the same values over here. So to just counter check, you just get plus that minus that value. We get a 0, it's okay. So you can see you're getting negative, you're getting nil all through like that. You're actually just checking whether this value is the same as that value over there like that. So we just delete or do away with this part over here. Delete. So we'll come and now use the formats. You can see there's a different format over here, and there's no borders over here like that. That was just something that we can be able to do as we finish off the base case. What are we being informed about the operating expenses? We go back now to the required part number 3, to the adjustments number 3. Highlight it as usual, put it up a bit. Operating expense ratio are modeled as the 3-year averages for the period from 2020 to 2022, these are assumed to remain constant over the forecast period. So what is the expense ratio? So the expense ratio relates to the sales. So operating expenses, expense ratio. So these workings over here are gross profit margin. Now here is expense ratio working, expense ratio. Like that. So expenses over sales. So that is that equation, expenses over sales, or operating expenses over sales. So you can just take this, put it over here, just pick the expenses, expenses, then you divide by the sales. Pardon me, put it the wrong place, just down the denominator, down here, sales. That. So we're going to use this same period over here like that. Sorry. Copy, Control V, pick the years. Then we put the expense ratio for 2020. So for 2020, we put the operating expenses. And just to counter check whether we're doing it from 2020 or from 2019, we've been told operating expense ratio are molded as 3 averages for the period 2020 to 2022. So we are 2020 to 2022 like that. So plus operating expenses, that divided by the sales over this. I have to pick 2019. You can see clearly it's 2019. So to do, just change that. It's very easy to change it. You just wait for the cross sign to change like that. Drag it there. So 2020, it's that value divided by the corresponding sales of that one over there like that. But now, because it's negative, we put brackets so you can be able to get a positive expense ratio. We put it like that, then we put a negative and before that, so that you can be able to get a positive. But we're saying it's a percentage. So we press Alt H over here, and we're saying we want percentage P. We spread P like that, you get 16% like that. And we're saying we can be able to drag that up to 2022 expense ratio. So what is the average? Just the same way we did over here for GPM, gross profit margin. We come to the formula bar, we pick average of which period for that value over there like that. So what do we say? We just pick average. You can see that. Which average are we looking for? The average over here. That, and close the bracket like that, and we say enter, and you can see that that's the average there. So to just check through whether we are actually doing the correct thing, check the question again or the adjustment. Operating expense ratio is molded as a 3 averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what do we do then? The expense ratio will remain constant all through like that. So we just drag that over here to remain constant at 19% like that. Oops, this should mean because it picks the formula, it picks the averages over there, so it cannot be able to do like that. So we just put 19% all through 19, 19, 19, and 19, because we all know that it is constant like that. So once we've done that, how do we then adjust these operating expenses? So you can see it's just the expense ratio times the sales. The expense ratio for 2023 is just that times the sales, the corresponding sales. So we just pick it like that. So plus the sales value multiplied by the expense ratio for 2023, like that. We get the value there. Remember, it's negative, so what do we do? Because the formula is there, we put negative, or then we'll just pick over there. So we put brackets, open and close brackets, like that. And we put before that, we delete and put a negative like that. You see, it's okay. So for consistency, to ensure that everything is consistent, we just drag it like that. It remains like that. So what do we do then to populate this one over here? You can guess it, just like the way I've already done it. I've just drag the formula like that. To counter check, does it pick the sales times the gross profit margin? Let's double check. So double click. You're picking the blue one, always begins, times the GPM, which rather the operating expense ratio, or the expense ratio, 19%. Then you escape. Just see that you've actually counter checked there. Operating profit, we know it is just given as the gross profit less the operating expenses. So we pick like that, plus, because there's a negative sign over here, plus that, plus, because we do not need to minus again. It will do minus, minus, it will give you a different value. That one, we get it like that. Then we drag, because it's a formula there, we just drag it like that. So what adjustment do we have as far as depreciation is concerned? We can now check our note over here, note number 4, you can see here. I highlight it for you. Depreciation to revenue ratio is assumed to remain constant as a 3-year average for the period 2020 to 2022. We do the same. Depreciation ratio. That. So we just come over here to insert the equation. There, it's a fraction. Come here and say that the depreciation ratio is just depreciation divided by the sales. Pardon me, sales. Like that. And if we have that, we just pick these values here with your permission. Copy, and we just paste it down over here, Control V. Depreciation ratio, for us to get the depreciation, we need to first of all, depreciation ratio from 2020, we just get depreciation divided by the sales. Plus, where is our depreciation for 2020? Depreciation is here for 2020, not 2019, like the way I had almost done previously. So you need to be very careful. That one over the sales, that value. And because it is going to give us a negative answer, we just preempt and put it in brackets like that. And we put delete minus. So plus minus for the formula is equals to that. We get a positive value. This has to be in percentage form. So again, Alt H P. So we increase it to see the percentage like that. So if that is the depreciation ratio, you can see it is L15 depreciation divided by the sales. That should be dragged now, moving across up to 2022, please, not up to 2027. What have we been told from 2023 to 2027? Depreciation revenue ratio is assumed to remain constant for the 3-year average 2020 to 2022. So it's the average. So it's going to be 0.9%. So you just copy that value, paste, Control V. Undo that. Then you Control paste special values, because it will pick the formula right over here. Values. Okay, like that. So the thing that I didn't highlight all of it over there, so we just undo again. We are copying this, copy, and we want to paste it over here. Paste special. We do not want all, because we'll copy the formulas as well, so we want the values. Okay, but now because they're not in percentage form, we just click that. It will give us the percentage form as it is, like that, 0.9%. How do we get the depreciation from 2023 to 2027? Depreciation, which is the numerator, is just the sales times the depreciation ratio. So We just come over here. Is equals to minus, so because it's going to give us a negative value, sales times depreciation ratio 2023, that, and we close the bracket, enter. Let's see, let's move back up and see whether it's given us that value. Yes, so we're picking that value. Format painter, we move towards the right like that, and it will just pick. Then what do we do? To populate this part, we drag, because the formula is going to be consistent. It's just going to pick. To double check, that as the sales times that depreciation ratio. We proceed on, escape. But here, profit before interest and tax should be a formula. Just like it's over here, but here it's not picked the formula because we just copied it from the exam worksheet. If you pick plus that, it will give us that answer, 1200. Recall it was the same. So if I want to see if it was the same, I just undo. You come over here, undo. You can see it doesn't have a formula, 1200. But when I redo, it now has a formula like that. So accountants are supposed to ensure consistency all through. So what do? I just drag that like that. And you can see what it gives us. How about finance costs, guys? Finance costs, let's look at what we're informed. Finance costs, I highlight. Finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate in year 2022 over the forecast. So how much it has reduced from the finance cost right over here? You see, from the previous year it was 9,000, it has reduced to 8,000, like that. So we are saying we are being informed that we use the reduction rate. So reduction rate, like that. So we pick the one for year 2022. So I'm going to come over here and work it out over here like that. So the reduction rate is plus that plus the previous year. It shouldn't be, did I pick the correct value? So plus this one minus that one. Yes, minus, not plus. So it's 1,000. You can even clearly see it's reducing by, from here, it has gone down to that. So the reduction rate should be 1,000 throughout like that. So how do we apply it? Plus, now it's going to be, we just drag these values until 2027, sorry, up to there. But you can see because of the format like that, so it's going to be copy. If you see it does like that, you copy, then you paste it like that, Control V. If it refuses again, guys, because this one has got a formula, you copy like that, you paste special. Remember what we did just before? Paste special. You're only interested in the values, not the formula. Values. It will pick. So what we're going to do is that we're going to pick, this one is going to be reducing by 1,000. So plus this one plus 1,000, 7,000, and we drag that all through. There is no constraint in as far as finance cost is concerned. You can see there is no constraint. Use the reduction rate in year 2022 over the forecast period. So 2022 it has reduced by 1,000, and that's it. Format painter like that. Profit before tax, we get plus that plus, because it's minus. You can see this minus all through. That's that. Like that. So even this profit after tax, before tax, sorry, plus that should give us that value there, and we just drag the formula across, moving like that. Income tax expense. Let's see what we are being informed. The final part. Income tax expense is calculated as the historical effective tax rate. Where did we calculate the historical effective tax rate? In part A of question 21. Where is part A? In the first tab just down here below, you can see it right down here. Yes. So we click there. What is the historical tax rate there? You can see it's 30%. So all this will be able to continue until 2027. So we come back to tab 21B. You can just come over here and have a working here, small working, tax rate. So finance cost, you can see right here, income tax expense, let me highlight it, is calculated as historical effective tax rate. So from 2020 to 2022 is 30%, Control V like that. But we need now, of course, continuously until 2027. Simply saying it's just going to be 30%. How do we get the 30%? Just to remind ourselves how we got the 30%. The tax rate was plus the income tax expense. I'm on 2020, yes, 2020. Income tax expense for year 2020, you can see 2020. That divided by the profit before tax. That. But because it's negative, we are saying we need to put a negative sign just before equals. Then we delete that one, delete, and then put a negative sign like that and open the brackets like that. Okay, it's decimal, but we put it percentage, Alt H P. But we need the format to be the same throughout. 2027, right there. So we can be able just to drag it to be the same. It should be the same up to 2022. But we cannot drag it over here because there's nothing we have put for the tax rate, income tax expense over here. So we copy this. Copy and paste special. The rate is what you're interested in. Paste special. Should we go to formats? No, we go to values, guys. 30%. So how then do we get the tax rate? Like that. So we can just get, it was this value over that value there. So we don't have, the income tax expense, we're saying we're going to charge 30% of this. So plus, right here, plus, or rather is equals to minus, because we want it into a minus sign, open the brackets, that times this value here, down here, 30%. Close the bracket. We should be able to have negative sign there. So we drag it. For you to have the plus sign, sorry, just yeah, like that, just drag it. Formatting should be the same. Come to format painter, you can see, come there. That. Here there should be a formula. Plus that one, plus that. Should have that. We drag the formulas going across like that. And that should give us estimate for the base case. The rest now, guys, we can be able to now just put in the same formats. So what we can do, we can just highlight that. You see format painter like that. Simply just put it like that. It will pick like that. That is for the base case. We can be able to move on towards the right of the screen. I'd initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here.
Welcome to Manifested Publishers.
We can be able to move on towards the right of the screen. I'd initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here. We copy the pessimistic case, right over here, pessimistic case. Pessimistic case, and of course because it's in capitalized, so pessimistic. that. For consistency, just pick that. Format painter, you can see format painter. Also good for presentation. We copy the years 2020 to 2022, like that. Because we're talking about the forecast period for the pessimistic case is going to be different from the base case. Copy. We can, right there, Control V. So we move towards the right, and one of the skills that you should also do or know is that we can be able to just hide this part here. Question is, will we be able to use all of this? We need them over here. So what I can do first of all, guys, before I hide, is to first of all pick these values over here. I'll just copy this, cut this, paste it right over here. Control V. So it moves towards the right. Now, if you allow me, I can pick right over here, up to that point, hide. How do you hide? You can, or you can be able to even group it. You can either right click and hide. You can see hide. It will hide. But we are accountants and we are experts like that. What we are saying is that we need to just put groups. So you come to data, then you group. Just click group. It will create this kind of thing. So you just click on this and it will just hide the data like that. If you want to unhide the data, you just click the plus. You open it up like that. That's what true accountants are actually supposed to do. So let's use the grouping outline. Now we come to pessimistic case. The reason for doing that is so that I can be able to look at the question and adjust them based on the inputs that, or these assumptions which have actually been provided right over here. So in a similar fashion, we forecast these values here, and we've already done that. So I ungroup this and allow me to pick these forecast values here like that. Copy. I press it back there. Control V. That. Now let's see how it actually changes the pessimistic case. We start all over again. I can put a white background home so that we can highlight as we make the changes. No fill, like that. Now we are doing the pessimistic case, guys, so please pay attention. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate is the first year forecast in year 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. So 10%. So what are you saying? 2022 CAGR over here. You can see in section, I can come down over here, 2022, the CAGR is down over here. You can see it right here. So we are saying what? We are saying that we are going to increase our revenue by, for the pessimistic case, is going to be 10% below the base case. So we are saying that even if the CAGR is increasing by 21%, the pessimistic case is going to be below by 10%. So we can come and say, right over here, the revenues, like in the pessimistic case, so you can click right over here, you can see is 115. So we're increasing this from the previous value, this one multiplied by 1 plus the growth rate which was there in M21A over there. And then once we have that, it's going to reduce by, it's going to be reduced, yes, by 2%, but it's going to be 10%. So pessimistic case, what we can do, we can just pick plus this value times, open the brackets, so 10%, 1 minus 10%, close the brackets like that, and you enter. We are accountants, analysts, we need to highlight that, put a bracket for consistency. Then we are saying that that is for pessimistic case because it's 10% below. And if that's the case for 2023, like that, then you are saying it's going to reduce by 2%, like that. So even if we were to decide to go this other direction, guys, like that, if you're able to go like this, plus that value times, we go to question 21A, this one times 1 minus, we're saying 10%, 10%, it gives us 18, but perhaps the formula should be delete that. No, it's not giving us that value, correct value, so pardon me for that. Let me just undo that. We are saying that it should be able to go down by 20, so 21%, it should reduce by 10%. So we delete here. We are saying this 21% of ours should reduce by 10%. So plus that one times, open the brackets, 1 minus 10%. Then you close the brackets. Comes to 18.8%. Put percentage like that. This is pessimistic case. Pessimistic. That 19%. Then what do we do after that? We come over to the second tab, tab 21B, you can see here, and we feed in the formula plus that sales, we multiply into brackets 1 plus this pessimistic rate over here, like that. Then we close the brackets like that and you press enter. So you can see it comes to 113. Because it is like the worst case scenario, we are saying compare that value or this 113 value over here, which you can put in a different color like that, with the one under the base case. Under the base case, you can see is 115 over here. So you put the same color like that. So you can see this is 115 base case, and this we're saying is pessimistic case or the worst case. It comes down like that. So I just undo like that, and then I proceed on. So once we have that, we come back now to what the question was actually saying. So the revenue growth rates, so the pessimistic case, optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods there. So we then reduce, this is expected to reduce by 2% annually until the last year of forecast subject to a minimum of 15%. So that is the limiting factor. That is the limiting factor over here. So plus this one times, open the brackets, and we need the rates over here first of all, sorry. So we come back to 21A over here, 19. So we pick pessimistic case plus that value minus 2%. We get 16.87, but now we are saying we want it to be consistent like that. We want to reduce the percentages to be only with no decimal places, so it's 17%. Then plus that one times, we're reducing it by 2%. Remember what we did over here, minus 2%. So plus that one minus like that. We're saying we're getting 14.87. So because 14.87 is less than 15%, so we're saying the constraint is 15%. So this is 2023, 2024, 2025 should be 15%. So we're saying that now this is our 2023 value, 2024, 2025, and right over there. But 2025 should be 15%. Remember from the question, let me come to tab 21B right here. The question was saying subject to a minimum. You can see it over here. Subject to a minimum right over here of 15%. Subject to a minimum of 15%. So what does this mean? We're saying that we can come over to this other side over here as we try and populate in this part. So we're saying it's plus that value times, shift, open the brackets, 1 plus for 2024. So we come back to 2024, we're saying it's 17%. That, we close the bracket, enter. Then these others will be 15%, 15%, 15% over here. So plus that value times, open the brackets, 1 plus 15%. 15%. That is the maximum, or the minimum we cannot go beyond that, beyond that value. We do the same, plus that one times, open the brackets, 1 plus 15%. We close the bracket, enter that. Then we can be able just to, even if we drag that, it would be able to pick like that. It's that value like that. So I was just doing it slowly so that we can be able to just see the values there. The cost of sales, we've been given the gross profit margin. What have we been told in the gross profit margin in the question? Right here you can see the gross profit margin. Let me just put it in beige, somewhat color like that. The gross profit margin for the first year forecast is the 3-year average for the period 2020 to 2022. So this is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 50%. So what is the gross profit margin? So I can come over here, move towards the right, and we reduce this base case scenario here. How did we do the gross profit margin? The gross profit margin is gross profit over sales. So the gross profit over sales, this one we had already done it like that based on 2020 values. So you can see, even if you're to pick this value over here, or we pick, let's say 2020, we can just decide to pick it over here, plus gross profit, which is over here, gross profit divided by sales, like that. 0.5. So for consistency's sake, we do the same right over here, 50%. And it applies all through until 2022. So we're saying that as far as gross profit margin is concerned, we are expected to apply these same rates that we have right above over here. So I can comfortably delete this one over here like that. I delete and say that now for me to be able to get the gross profit, I'll just get, you can see the gross profit right over here. You just multiply gross profit margin times the sales. So gross profit, so I get plus gross profit margin, 57%, multiplied by the sales. There, I get it like that, 64. So I drag the formula like that and it picks. So for us to get the cost of sales, we just get plus 113, but because it is minus, we open the brackets, you can see on the formula bar right over here, we just delete that, say is equals to minus that value minus that value there. We close the bracket, say enter. And we drag this towards, pardon me, undo. So plus or is equals to minus, open the brackets, 113 minus 64, close the brackets, enter 4, then we drag the formula until we get the plus sign like that. We drag the formula like that, then we put it in terms of the format, just put it like that. So we can try and check plus that plus the cost of sales, we're getting 64,381 to 2.29. So we can just, put it like that, and you can see we've gotten the correct answers like that. So we delete operating expenses. We go back to the question, right down here, highlight in peach. Operating expense ratio are modeled as the 3-year averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what are we saying? We are saying that the expense ratio will also apply across. You can see the expense ratio just down here. So we pick, for us to be able to compute the operating expenses, because we've already done that in first part here. The operating expenses is just the sales times the expense ratio. So for us to get this, it is just plus the sales times the expense ratio. The expense ratio is right over here. Enter. But remember, it is negative. So we put a minus there and we open the brackets like that. Picks negative. And we just drag it, formula, like that, and it picks. Do the same thing as we've done above, format. That it picks the same format. How about operating profit? Let's see what the question is saying about operating profit. There's nothing about operating profit. It's a formula. So it's only operating expenses was there. So plus, it should be the same, plus that. You should get 42. Drag it like that. Let's see what they say about depreciation. Yes, there's something on depreciation. It's right there. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for period 2020 to 2022. So we apply the same formula we've done just over here. You can see it right here. For us to be able to get the depreciation value, sales times depreciation ratio. So we come back towards the right over here, pick like that, time plus sales times depreciation ratio for 2023. Is that correct? Yes. Enter. And that's it. We drag it. That picks. But you can see clearly it's not the same format as this other one. So we do the same thing. Minus, open the brackets, close the brackets, enter. And then now we can redrag it again. Just drag it like that. It picks the negative sign, format, just do it like that, and that's it. Then we can just say profit before tax plus that. That. And of course, because this also requires the formula, you can see it will not change anything. But the format will change. So let's just undo that. We ensure that the format is the same as the previous income statement. So we just copy it like that, and that's it. What are they saying about finance costs? The finance costs down here, the finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate 2022 over the forecast. So you can see here reduction rate is 1,000 based on the base case. Like that. Let's see how much it's reducing by in this case over here. It's reducing by still 1,000 like that. So how do we feel it? We just say plus this one plus that, so that we can be able to get 7,000. And we just apply it across. Format painter, to the same there. Profit before tax plus that plus this value. And we drag like that. How about the income tax expense? Let's move over to the right, to the left rather. Finance cost we've just done. Let's go to income tax. Is calculated as the historical effective tax rate. Put it as pitch, because we are saying it's just going to be plus that value times the 30% 2023 value there. That's it. Because it's negative, do the same thing. Negative, open the brackets, put it in brackets, like so. So you come over there and just drag it like that. We drag the formula as we move across like that, and then we get the final profit after tax. Plus that, enter. That's the final value that we have. So you can compare. You can see in the year 2027 forecast, we are getting 40,000 as the profit after tax in the pessimistic case. How about the base case? Let's remove this plus sign over here, the base case. We are getting 42,694 because it should be higher than this case over here, which you're saying is pessimistic case. So let's now put the format, we just put the paint, or rather the format, we try and format this whole part like that. And that's what we've done. That. So once we have that, we can then just move ahead to the base, to the optimistic case.
Welcome to Manifested Publishers. Welcome to Manifested Publishers.
So once we have that, we can then just move ahead to the base, to the optimistic case. We just, first of all, before we group, we'll just copy this part again, copy, and we can skip this part towards the right there. Control V. Even if you were to just delete this part over here now, delete it, that, or we can just undo and undo. And we select this part and just say cut instead of copy. Cut there. And then we paste it right here. Control V. So that now we don't get disturbed by the space. And we copy this part up to 2022. Like that again. Copy. Sorry, I said cut. This should be copy. And we put it right above right here. Control V. And this case is what? Optimistic case. Optimistic case. In a similar font, just put that right there. And here we can just be able to group it right over here. So we group. Where do we group? We come to data. We come to group. You can see group here. You press the above one. Group, that thing comes. This kind of grouping comes. In terms of the outline, let's group it there. So we have even this one for the base case. Let's group it. We want our forecast to be from 2023 to 2027. So you can see I click this one, copy 2023 to 2027 like that, copy, and then we reduce the grouping right over there and compress Control V. it comes. Now let's look at systematically, step by step, what changes we have to make. So we again go through this. Clear the font, no fill. We make adjustments. Revenue growth rates are the forecast under the three scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year and forecast is 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. Optimistic case is 20% above the base case. So we can come right over here to 21A down here. And we're saying it is 20% above. Here is a pessimistic case. We said it was 10% below. So you can come over here, optimistic, here, and say that it is plus this one, plus this one times, open the brackets, 1 plus, not minus, 1 plus 20%. It's above. So 20%. So for purposes of consistency, like that, 25%. So you increase 21% by 20%, it comes to 25%. So what are we told? We come back to tab B. 20% above the base case. So the base case was 21%, yes. So we are saying that it is expected to reduce like that. And we can say that now, come back over here, plus 22 like that, times, open the brackets, 1 plus, we come to this value here. That value, close the brackets, enter, 119. So for font, keep the font the same. Once you have 119, it's expected to reduce by what percentage? By 2%. So plus this one minus 2%, 23%. Then plus this one minus 2%, that 21%, and so on and so forth. As you move along, move along up to there. So what are we saying? This is 2023, and we can be able to increase like that until 2027. So fill series. So this will be the rates for the years over here. This is the years, bold that. These are going to be the rates right here. So we've picked 25% for 2023. Now we need to pick 23% for 2024. So we pick plus that value times, open the brackets, 1 plus what? The one for 2024. We come back to tab A. 2024 you can see is that one there. Close the brackets, enter, like that, and you do the same. Plus that value times shift, open the brackets, 1 plus what? We are picking 2025. We come to tab, this next tab over here. 2025 you can see is 21%, and close the brackets, enter, like that, and then plus that value over there times, open the brackets, 1 plus what? We're picking 2026. So we come back over here, 2026, and right over here is 19%. Like that. You close the brackets, and then you press enter. And then we are saying we press plus that value times, open the brackets, 1 plus what? we're picking 2027. Come back over here, 2027 is 17%. It's not reached the threshold of 15%. Like that, we close the brackets and we press enter like that, and that gives us the revenue under the optimistic case. How about cost of sales? We already have the gross profit margin. So you can be able to compute the gross profits very easily like that. So we just come over here, highlight like that, the same format, painter there. We're saying it's just going to be given as the sales times gross profit margin. So plus that times the gross profit margin for 2023, that over there, gross profit margin is that. Once we have that, we just drag the formula moving to the right there. And then for us, it's going to be is equals to minus, so we open the brackets right over here, that one minus that value, and we close the bracket like that, so that you can be able to get it consistently as a negative value there. So for format painter, you move across like that, and then you can now drag the formula moving towards the right. So to just check, so plus that gives us, so you can see this answer is the same as that one there, and even if you are to drag it moving towards the right, of course you can see that one is the same as that. Of course the decimal places over here come into play, but don't worry about that. It's actually the same. These are actually the same values there. So delete that for now. How about the operating expenses? We have the operating ratio. They are given to us there. We've been told, so revenue is done, put pitch there. Gross profit margin is done. We've done that. Operating expenses are modeled 3-year averages for the period 2020 to 2022. These are assumed to remain constant of the forecast period. So we just pick the expense ratio. To get the operating expenses is just the sales times expense ratio from 2023. Sales times expense ratio. So plus, so is equals to minus, because it's a formula like that, times the expense ratio, because it's operating expenses, expense ratio 2023, ndio hiyo iko hapo like that. Close the bracket, enter, move up. So negative value formatting, come to format painter like that. Of course in the exam you don't need to just really bother yourself with the format, but I'm just doing it because of to ensure that we have consistent results there and consistency in terms of presentation. That's it. We just drag the formula like that. How about operating profit? Plus that should give us, that's so. I said plus that value should give us 44 there. Just drag it like that. It gives us the same, consistent answers. Format painter. Depreciation. We've been told that depreciation, we finished operating expenses, we've been told depreciation down over here to revenue ratio is assumed to remain constant over the 3-year average for the period 2020 to 2022. So we should remain here then 0.9%. So it's just going to be the sales times depreciation ratio. So it's just going to be plus sales times depreciation ratio 2023 there, enter. Once we have that, we drag the formula towards the right, and we can be able to ensure consistency. So minus, then we open the brackets, close the bracket like that, enter. But now here it should be negative. Oops, like that. How about the profit before tax, before interest and tax? Plus that, get the answer straightforward, move towards the right. Format painter, there. Finance costs, ladies and gentlemen. We are saying finance costs, we've already done depreciation right over there. Come to finance costs. They are expected to reduce steadily as the loans are repaid. Use the reduction rate in 2022 over the forecast period there. So In a similar fashion, plus that one minus, this is the depreciation rate, reduction rate. So 2023 there. Oops, it should be plus, this is 2023, that one minus that. I'm pressing minus or plus, sorry. Plus that one plus 1,000, yes, 2023, that. Yes, that's the correct value. Sorry, using this wrong formula. We drag it like that. Format painter. Profit before tax plus that, get that. We drag the formula like that towards the right, and we use format painter. Finally, or rather semi-finally, second to final, income tax expense. We've been told the income tax expense and the finance cost we've done. Income tax expense, calculate the historical average effective tax rate. Highlight that to show that you've done it, and it's just going to be plus that times this value here, like that. But because it's a negative, so you put negative minus, open the brackets, close the bracket, enter. So we drag there. Finally, we have the profit before tax plus that, should be able to have those values like given to you there. So format painter, you can see the values right there. So 2023, I need to ensure that there's consistency in terms of the presentation or the outlook over there. You can be able to see that we have concluded the optimistic case. So we have answered part B of the question. Prepare 5-year forecast statements for profit and loss for Sepetuka Limited from 2023 to year 2027. So just to recap what we've discussed, we were told to prepare a base case income statement, a pessimistic case income statement. You can compare, the 42 represents the base case, and the 40,000 represents the worst case or the pessimistic case, and towards the right over here you can see the optimistic case is 50, it's slightly higher as compared to the previous two there. So this answers part B. Hope you have enjoyed the lesson. Thank you for being with us, and God bless you.
Welcome to Manifested Publishers.
Welcome learners to our today's session. My name is Celestine Wandabusi, and we are continuing with the revision management accounting December sitting. Today we'll be proceeding to question number 4 of the previous lesson. So question number 4, part A, we are told that outline 6 benefits that might accrue an organization as a result of preparing budgets. So 6 benefits for budget preparation, or which might accrue an organization as a result of preparing budgets. So number 1, I'll give a summary, then I'll explain. Number 1 is planning. We have a benefit, it is assisting in planning. 2, it will assist in controlling. Number 3, in coordination of activities. Number 4, can motivate, so we have motivation. Number 5, clarity of responsibility and authority. And then number 6, we have planning, we have controlling, we have communication as number 6. Communication tool. So 6 benefits for budget preparation. What are the benefits? When we prepare budgets, we do a financial or a monetary plan. And whenever we do a plan, it means that when we are spending or whatever activity we undertake according to that plan. And when we are doing that, it will help an organization, especially in allocation of scarce resources. Where there are no resources, an organization will be able to know where to allocate, when to allocate, so that is able to minimize costs to do with financing costs. And that is the work of planning. Like when we are preparing a cash budget, we normally look at what are the expected receipts, or what are the receipts and what are the payments. So when the payments exceeds the receipts, it means that we'll end up having a deficit budget. So when we have planned and we have a deficit budget, it will prepare an organization to know where it can be able to get funds to finance those activities or those expenditures that are yet to be financed. And then controlling is simply where we are looking at the actual results and that which was budgeted, so that we see whether there are any variances or discrepancies that will help an organization or the management to know the necessary actions to be undertaken. So through budgeting, we can be able to do the controlling function. How? We will look at our budget. What was that was budgeted? And what is the actual result? So when we have that which was budgeted and the actual result, we will be able to know the variances or the differences between that which was budgeted and that which is the actual. Like you had budgeted to spend 100,000. You have now spent 150,000. What is the difference? That is 50,000. Why 50,000? Is it favorable to an organization or not? And if it's not favorable, then which action should the firm undertake to ensure that that is not repeated again? That is, it is assisting in controlling function. And then coordination of activities. Through budgeting, all the activities of an organization can be coordinated. How? When we are preparing budgets, we do involve all the departments in an organization. And when we are involving all the budgets, we normally have budgets depending on others before they can be worked out. Like when we are preparing for Department A, sometimes when Department B is budgeting, sometimes it has to base on the activities of Department A before it finalizes on its activities. And through that, we will have coordination of activities relating one department to the other. Motivation, how can budgeting result to motivation of employees? When a budget is formulated, there are some targets that are normally set. When those targets are tight, they motivate the managers to work towards achieving them. And so, like when we have a plan of producing 100,000 units, the management the manager who is responsible for the production department will have to ensure that he is able to produce 100,000 units. And so how does he do that? He is motivated to produce 100,000 because it is laid down in that budget for it to be met. And because of that, he will work towards achieving the 100,000 units, and that's what we are referring to as motivation. So where there are no budgets, managers will work the way they want. But if we have budgeting, it is motivating them because of the targets that have been set. Then number 5, clarity of responsibility and authority. In budgeting, we consider the high-level management involving themselves in budgeting. though we have the mid-level managers and the lower level, but now when it comes to lower level managers, they associate themselves with the workers who are the subordinates. So to get all the information concerning what need to be done, we have these supervisors or the lower level managers who associate or relate with the subordinates so that they are able to report to the immediate supervisors who then will report to the highest level. And when such happens, we are able to clarify, or the organization can be able to clarify who is to do ABC, like during the budgeting process, and who should you report to. In other words, who is your senior. That is normally done during, like when we talk of the budget committee is outlining the management and the responsibilities of all those that are involved in the budgetary process. Number 6, communication tool. A budget can act as a communication tool, and therefore it has a benefit of acting as a communication tool. During the budgeting process, this budgeting process is involving communication. We have liaison of one department with the other, and that's done through communication. We have both vertical and horizontal communication, and therefore we say that a budget itself is communicating what needs to be done, and during the budgeting process, again, there is communication that is involved. And therefore, through budgeting, we can have a benefit of a budget being used as a communication tool. That was part A of question number 4. Then we move on to part B. We are told that you are in charge of making forecasts and preparing budgets for Condé Limited. You have been supplied with the following cost and revenue forecast and details of payment. So we have been given a forecast for revenue and cost for half year of 2022. So the details are beginning from January to June of the year 2022, and then we have additional information. Note number 1, cash balance, that is on 1st April 2022, is expected to be 90 million shillings. Note number 2, period of credit allowed by suppliers averages 2 months. Note number 3, debentures worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. Number 4, a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in the month of May 2022. Note number 5, sales commission of 3% is payable after 1 month of sale. And then note number 6, a dividend of 100 million is to be paid in June 2022. Note 7, there is a delay of 1 month in payment of overheads and wages. Note number 8, 20% of debtors pay cash, receiving a cash discount of 4%, and 70% of debtors pay within 1 month and receive 2.5% discount, while the remaining debtors pay within 2 months without a discount. Then required, a cash budget on a monthly basis for the months of April 2022 to June 2022. So when we prepare a cash budget, you need to understand what a cash budget is. So a cash budget is simply that budget that is recording the expected cash receipts and the expected cash payment. So we do not include any credit transaction on a cash budget. Where we have credit transactions, then the interest is when should this cash be received, or when should this cash be paid. So in the period when cash is received is when we record that on the cash budget, or a payment made is when we record on the cash budget. So we'll prepare the cash budget. So we have that format for preparation of a cash budget. So we are concerned with the month of April, May, and June. These are the periods for the budget. And so we will have details under that. So we'll begin to interpret the additional information. We are told that cash balance on 1st April 2022 is expected to be 90 million. So cash balance is simply that balance that is to be brought forward. So what we do, we bring it forward. This is cash balance that is brought forward. And it will be brought forward, we are told, cash balance on 1st April, which is expected to be, so that we'll record 90,000 instead of 90 million. So that is note number one. Cash balance on 1st April is expected to be 90 million. So this is our cash that is to be brought forward. Then note number two, we are told that period of credit allowed by suppliers averages 2 months. So remember, suppliers are those people who are giving this organization goods on credit. So that means they are the creditors to the firm. So they are allowing a period of 2 months. 2 months means, for example, if we have direct material purchases, we were given from January to June, and we are interested in preparing the budget for the month of April, May, and June. So when is this payment to be made? Giving an example, meaning when we have direct material purchases for the month of February, 2 months credit means those that were taken on credit in February are to be paid in April. So when we are preparing the cash budget, we will indicate that. Note number three, we are told that debentures worth 125 million are expected to be issued in May. So our interest is when are they issued, not when they are issued, but when is the receipt of that payment. So the amount is to be received in the same month. So we'll record that. And then a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in May 2022. So we simply record that amount based on that month, and then we will show the workings. Our number one working is note number 5, sales commission. Sales commission. We are told that sales commission of 3% is payable after 1 month. So that means if we are to calculate for the month of, so we want to calculate for the month of April, May, and June. So how will we calculate that? To calculate the sales commission for the month of April, we are looking at the sales for the month of March. What were the sales of the month of March? The commission for March is to be paid in April. And so for the cash budget, we will make payment in the month of April. So for April, we are taking 3% times the March sales, which were 440,000. For May, we will take the sales for April, which is now 3% of the sales of April, 350,000. What will we get? Then for June, we get the sales of May. That's 3% multiplied by 360,000. Then that will be the commission. So 3% of 440,000. This is 13,200. Then this will be 10,500. This is 10,800. So those are the amounts we'll use in the cash budget. We move on to note number 6. We are told that a dividend of 100 million is to be paid in June. So we will pay that in June. Note number 7, there is a delay of 1 month in the payment of overheads. Delay means there will be a lag in payment. So the payment that was to be done in the month of March will be done in the month of April. That were to be made in the month of April will be in May and so on. So there is a delay of 1 month in the payment of overheads. We've been given the overheads. So we have note number 2, overheads. Overheads. So the overheads here are including production. So what will we pay in in April for production? In April, April, we have May, and we have June. So for production overheads, those that were to be made in March will be made in April. So in March we had 40,000, which is now to be made in April. So we simply write 40,000. For May, those that were to be made in April are the ones that will be made in May, which is 45,000. And then in June, those that were to be made in May are the ones that will be made in June, and that is 36,000. And then we also have administrative overheads. We have another 1 month lag. So those that were to be paid in March are to be made in April. So we have 27,000. And then for April of 24,000 will be made in May. And for May, 25,000 is to be paid in June. We also have selling and distribution. Selling and distribution, we also have 1 month lag. Those that were to be paid in March will be paid in April. That's 18,000. That which was to be paid in April will now be paid in May. That's 13,000. And that which was to be paid in May will be paid in June, which is 11,000. We were also told, and wages. We also have a delay of 1 month for paying wages. So the wages that were to be paid in March will now be paid in April. Those that were to be paid in April will be paid in May. Those that were to be paid in May will be paid in June. That's note number 7. Then the last note, number 8, we are told that 20% of debtors. So we calculate debtors, cash collections. So we have cash received. We are still using the month of April, May, and June. So what were the cash collections? We are told that 20% of the debtors pay cash. So we are to get 20% of the debtors in the month of April. So if we want to know how much was received in April, because it is received in cash, we calculate in April. So we have 20% for April times 350,000. 350,000. That will give us for April 20% of 350. That's 70,000. So for May, you are also getting 20% of May, which is now. So that is for April. The cash that was to be received in the month of February, April was 70,000. But on the same note, number 8, we are told that a cash discount of 4% was given. So when a cash discount is given, it is allowing or prompting the customers to pay promptly. And when they pay promptly, they pay less than what they should have paid if they were to pay at the end of the credit period. So that means when the firm is allowing that discount, it will receive less cash than what it will have received. And therefore, we are to subtract a discount. We have discount, we less discount at 4%. And discount at 4% simply means it will be 4% of 70,000. They were to pay 70,000, but because they are given a discount of 4%, they will not pay all the amount. And so what the firm receives is less than what they would have received. So 4% of 70,000 will be 2,800. So we subtract that, and whatever we get will be the cash received. So this is 67,200. So what we'll put to the cash budget will now be 67,200 and not 70. Why? Because there was a discount that was given to the debtors. We do the same for the month of May. So for the month of May, we are to calculate 20% of the May sales. 20% of the May sales. So the May sales were 360. 360, sorry. May sales were 360,000. So when you calculate that, this will give us 72,000, and then we are to less 4% of 72,000, which is 2,880. So we subtract this, and this will give us 69,120. This is the cash that is received. Then for the month of June, we also have 20% of the June sales, which were 360,000. So this will give us 72,000, and then we less 4% discount of the cash that was to be paid at the end of the credit period, which will be 2,880. So when you subtract this, we'll get 69,120. This will also be the cash to be received. Then, on the same note, number 8, we are told that and 70% of debtors pay within 1 month. Paying within 1 month means when they buy in the month of April, before the end of April, they will have paid. So that means that amount is again to be recorded in that very month. So to calculate that, we also have now the cash collection at 70%. For the month of April, the sales were 350. So we get 70% of 350,000. And this will give us 245,000. We less a discount of 2.5% on 245,000. This will be so we less 6,125. Which will give us 238,875. Do the same for the month of May. Get 70% of the May sales, which were 360,000. This is 252,000. And then we less a discount of 2% on that which was to be paid. And this will give us 6,300. So when you subtract the cash, this is the cash collection. The cash collection will be equal to 245,700. And then for June, so the June sales equal the May sales. So we have 360,000, which will give us 252,000. Then we less 2.5% of 252,000, which will give us 6,300. So when we subtract, we will get 245,700. And then lastly, we are told in the same note number 8, we are told that while the remaining, so remember we had 20% of the debtors, we have 70%. So it means we still have a balance of 10%. So the remaining 10% pay within 2 months without a discount. So without a discount means we will calculate on the sales, and the 10% is what will be paid, but after 2 months. So since we were given sales from the month of January, it means that those that were to be paid in February will be based on the sales that were made in, those that will be paid in April will be based on the sales that were made in February. So cash collection at 10%. Cash collection at 10. This was at 70%. So the cash collection at this for the month of April will be equal to 10% of February sales. 10% of February sales, which is 350,000. So this will simply give us 35,000. Then May, it will be paid in 2 months. So meaning those that were were given out in March are the ones to be received in May. So March sales, we get 10% of 440,000. And this will give us 44,000. Then June, those that are to be paid in June will now be calculated on the April sales. So we get 10% of 350,000. And again, this will give us 35,000. So once we make those adjustments, we now come to our budgets and simply put in the figures. So once we have the cash balance that is brought down, we are to identify the receipts. We add receipts. So what are the receipts in the question? The receipts, we have the cash received. So we have cash from sales. For the month of April, what was the cash? We have 67,200. For the month of May, the cash received was 69,120. And for the month of June, we had 69,120. Then we have cash collection. Cash collections from debtors. So the cash collection from debtors for the month of April, we are taking this cash collection at 70% and the other cash collection of 35% or at 10%. So we have 238,875 plus at 10% 35,000, and this will give us 273,875. We do the same for the month of May. For May, the cash collection at 70% was 245,700, and at 10% for the month of May was plus 44,000. So this will give us 289,700. Then for the month of June, this was 245,700 plus 35,000. And this will give us 280,700. That is the cash receipts and collection from debtors. We also look into the question to find whether there were any cash receipts. In note number 3, we are told that debtors worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. So these debentures will be issued in May. So we have debentures. The cash received will be in May and the amount is 125 million. So you simply record in that period. There is no other cash receipt. So we underline this. So after showing the cash, we will calculate total cash received, which is simply the addition of this. So we show payments. So before I add, we'll show the payments. In the question, we had payments, we have commission. Commission was a payment. That is not number 1. So this is working number 1. This was overheads was number 2. Debtors was number 3. That's cash received number 3. Cash collections number 4. So cash From sales, this was working number 3. Cash collections, this is working number 4. And then commission, we have commission as part of payment. Sales commission. Sales commission. So sales commission for the month of, this is working number 2. Working number 1, not 2. For the month of April, we had 13,200. May, 10,500. And for the month of June, we have 10,800. Then the next cash payment is note number 2, that's overheads. So we have production overheads. This is working number 2. Production overheads, April was 40,000, May 45,000, and June 36,000. The next is administrative overheads. Still working number 2. For April was 18,000. May 13,000. And June, no. For April, administration should be 27,000. 27,000. For May, we have 24,000. And for June, we have 25,000. We move on to selling, distribution. Selling and distribution. Still working number 2. For the month of April, we have 18,000. May, we have 13,000. And June, we have 11,000. We also have wages. Still working number 2, wages. For April, we have 100,000. May, 72,000. And June, 54,000. So that was note number 7. Note number 5, we were told that, note number 5, note number 4, a new machine will be installed in March. So we have installation of new machine. We are told that a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in May. So we make payment in May, and that is 150 million. Note number 6, a dividend of 100 million. So we have dividend. A dividend of 100 million is to be paid in the month of June. So we will pay a dividend of 100 in the month of June. We were also told in note number 2 that period of credit allowed by suppliers averages 2 months. So the period of credit is applying to direct material purchases. When you look at direct material purchases, we were given from the month of January to June. So we are told that the period of credit allowed by suppliers averages 2 months. So we need to make credit purchases. Credit purchases. So the credit purchases are on direct materials. And so if given 2 months period, it means that that which was given in the month of February is what will be paid in the month of April. So for us to record the payment, we are recording the payment for the goods that were given in the month of February. So for April, we record that for the month of February. And for May, we record for the month of March, which is 135,000. And for June, we record for the month of April, which in that case is 90,000. So that's how we make payment. So for the month of April, we allowed the month of April and the month of March, so that the payment is made in the month of April. Then for those that were given in March, we are allowing 2 months credit so that it is paid in May and so on. So from there, we simply make the calculations. And when we are calculating, we begin with the first period, which in this case is April. So we'll get the receipts. So the total receipt is 431,075. We also show the total cash payments. So we will have total cash payment, and then cash balance that is to be carried down. So we do the cash payments for the month of April. So this is 298. Sorry, first. So this is 298, 200. So the cash balance is cash received minus cash payment. Which will give us 132,875. We do the same for the month of May. So this balance is now to be brought forward. This is 132,875. We bring it in the next period. So this will give us 616,695. This will be 449,500. So we get the cash balance to be carried forward, which will be 167,195. And then we bring it in the next period, 167,195. So the total cash here is 517,015. So this will be 326,000. 800. Then we get the balance to be carried forward. And this will be 190, 215. So when we get a positive balance, that simply means it is a surplus. A surplus means the firm had more receipts or is expecting to receive more than what it will spend, and therefore there will be a surplus remaining which can be used for other purposes of the firm. And that was all about question number 4. So you can read more on budgets and budget preparation. We have fixed and flexible budgets. You can look at other budgets, functional budgets like sales, production, labor, and fixed overhead, etc. And that brings us to the end of our session today. Bye-bye. Let's meet in the next session.
We move to part B of the same question, that is question 2. We follow it keenly, word by word. It says, Triplecom Insurance Company Limited is a resident company carrying on both general and life assurance businesses. The following information relates to the insurance company's business for the year ended 31st December 2020. Triplecom Insurance Company Limited is a resident company carrying on both general and life assurance businesses. The following information relates to the insurance company's business for the year ended 31st December 2020. So we have two columns, that is general insurance and life assurance. So we have these items for each of those businesses. We have profit on sale of investments. We have premium received in the year, commission ceded, premium returned, recovery from reinsurance company, premiums paid to reinsurance company, commission expenses, management expenses, traveling expenses, marketing expenses, fees paid to investment managers, legal expenses relating to claims, general expenses, bad and doubtful debts, claims paid in the year, and bonus utilized in reduction of premiums. Additional information 1. Claims outstanding for general business were as follows. Claims outstanding for general business was as follows. Remember, claims are the major expenses under general insurance. So we are told claims outstanding for general business was as follows. 1. As at 1st January 2020, that is at the beginning of the year, 6.64 million shillings. That is claims outstanding at the beginning of the year. 2 is claims outstanding as at 31st December 2020 of 7 million shillings. That is outstanding claims at the end of the year for general insurance. So what we shall do is simple. We shall have to adjust the claims account as required so that we determine the allowable claims for the year 2020. 2. General expenses under general insurance include cost of computers of 800,000 shillings and cost of saloon car of 3.26 million shillings. General expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3.26 million shillings. Now, cost of computers is a capital expenditure which we shall disallow, but then we shall allow for capital allowance on computers. That is wear and tear allowance. Currently, wear and tear allowance on computers is at 25%. So we shall disallow the cost of 800,000, but then we shall allow for capital allowance of 25% of 800,000 shillings. Still on the same note, we have cost of saloon car of 3.2 million shillings. Now, again, this is a capital expenditure. We shall disallow the cost, but we shall allow for capital allowance. Now, this is saloon car. A saloon car is a non-commercial vehicle. Currently, qualifying cost for non-commercial vehicles for capital allowance purposes is restricted at 3 million shillings. So we shall do 25% of 3 million shillings. So we shall not use 3.26 million shillings because of that restriction. 3.
Reserves for unexpired risk for general insurance was full. That is provision for unexpired insurance. As at 1st January 2020, 3.24 million. Then as at 31st December 2020, 6.2 million shillings. Remember, in taxation of insurance business, an increase in reserve or provision for an expired risk is treated as an allowable expense, while a decrease in the same is treated as a taxable income. So what we shall do is to adjust the reserve for an expired risk, and then we shall determine the taxable amount for the year or the allowable expense for the year. We shall do that as our working. Note 4. The life insurance fund balance was valued by an actuary at 310 million shillings as at 31st December 2020. 8% of this fund balance was recommended to be transferred for the benefit of the shareholders. At the beginning of the year, the fund had been valued at 250 million shillings. 10% of the surplus was recommended to be transferred for the benefit of shareholders. Now, this is now specifically on life insurance or life assurance business. Remember, the rule is where an insurance company does both general and life insurance businesses, then the two are treated as separate businesses. And so we shall determine the taxable income of each of these separately, then we put them together to get the total tax liability of the company for the year. So this is specifically touching on life assurance. We shall talk about it more when we shall be determining the taxable income under life assurance business. 5. Outstanding premiums in respect of life insurance business was follows. Outstanding premiums. So as at 1st January 2020, 12 million. As at 31st December 2020, 9.2 million. Again, this will help us determine the premiums for the year 2020 under life insurance business. And finally, note 6, other income received by Triplecom Insurance Company Limited. This is what was actually received. And we know we receive interest income net of withholding tax. The withholding tax rate on interest income is 15%. So here we are told interest income received from fixed deposit account was 780,000 shillings, meaning this is at 85%, and it is a taxable income. What we shall do is to gross it so that we get the taxable amount, but under tax liability we shall deduct the withholding taxes already paid. 2 is dividend received from qualifying company. Dividend received from qualifying company of 3 million shillings net, meaning the 3 million is after withholding tax has been deducted. And we are told it is dividend received from qualifying company. In other words, this dividend income was received by this company from another company in which it controls 12.5% or more of the voting power. So in that case, this will not be taxed again. 3, lastly, the company owns the building which houses its offices. Part of the office space is rented out to other tenants. In the year to 31st December 2020, the company received 2.8 million shillings net rental income from their estate agents. Property management fees amounting to 3.2 million shillings for the year to 31st December 2020 had not been deducted. Now this is allowable income under rental income, allowable expense under taxable rental income. So what we shall do, we shall have the amount received of 2.8 million shillings. Then we deduct the allowable property management fees of 3.2 million shillings. The difference will be a taxable rental income. So we shall do that and it's a computation. Required. The taxable income or loss for Triplecom Insurance Company Limited for the year ended 31st December 2020 for 12 marks. So one, I said, where an insurance company has both general and life assurance business, the two are treated separately and taxed separately. So what we do is simple in this case. We shall work out the taxable income under general insurance business, Then we also work out the taxable income under life assurance business. Then to get the tax liability, we get we multiply the corporation tax rate by the sum of the two taxable incomes. Good. So let's start with general insurance. So that is question 2B. Question 2B. So we start with the general insurance. So here we have an income statement. Sorry, we don't have an income statement provided. So it means we can only use the gross profit approach. So we can do it like this. We say triple com. Triple com insurance company limited, taxable income computation for the year ended 31st December 2020. We can carry 3 zeros to ease our work. So what we start with is premiums. We start with the premiums. So we work out net premiums. So we have premiums received in the year. We say here premiums received in the year as 15 for 50,000. Then we adjust the premiums received with any items that are available. If you move downwards, we have what they are calling returned premium. That is premiums that were received by the insurance company from the insured, but given back, or rather returned back to the insured. So that means we deduct it. So we write here returned premiums. We have 374. We have what they are calling premiums paid to reinsurance company. That is still a reduction. Premiums paid to reinsurance company at 76.80. We deduct. Now, note 5 says outstanding premiums in respect of life insurance business was follows. Now that is for life, not general, so we can't use it here. If we had the same under general insurance, we would add the outstanding premiums at the end of the year and deduct the outstanding premiums at the beginning of the year. But the ones we have are for life assurance, so we don't bring them here. Any other items affecting premiums? We have the last item down there called bonus utilized in reduction of premiums. That is an addition. Bonus utilized in reduction of the premiums. That is bonus that were to be paid to the insured, but then the company retained them for purposes of in exchange of premiums that were to be received from the insured. I'm looking for any other item affecting premiums. We do not have any. So we get the sum of all this very keenly. We have 15 for 50 less 374 less 76.80 then we add 180. We have what we call net premiums. Net premiums of 75, 76. That is net premiums. At that point, we say add other taxable incomes. That is, we add any other taxable income the firm had under general insurance. Add other taxable incomes. So we look for any other taxable income the company could have had under general insurance, then we add them at that point. Good. So we look at we look at the list provided. If you are keen, there's what we call commission ceded. That is commission that was received by this insurance company from another insurance company for giving them insurance business. So that is a taxable income in the books of this company. We can have what we call commission ceded or commission paid. Now, if an insurance company A gives insurance business to another insurance company B, the insurance company selling the insurance business receives a commission from the other insurance company. That is called commission on reinsurance ceded, which is a taxable income in the books of the receiving company. On the other hand, the company that is given insurance business pays a commission to the insurance company giving it insurance business. That commission would be an allowable expense. So in this case, we have commission ceded, which is a taxable income. So we add, so we write here, commission ceded, 8 million shillings. If you move downwards, we have under note 3 says reserve for an expired risk for general insurance was followed. So we have the reserve at the beginning of the year and at the end of the year. What we do is to run this account. Then if it is a taxable income, meaning if it was a decrease, we tax the decrease. If it is an increase, we allow the increase as an expense. So that means we have to run working one. So we run a small working one. So I'm running reserve for an expired risk account. Reserve for an expired risk account. So balance brought down, we credit because it's a liability. So we say balance brought down, note 3 that is, it is 3.24 million. Then we have balance carried down. Balance carried down of 6.2 million shillings. We balance off the account. This is 6.2 million. 6.2 million. It means there was an increase which went to the income statement as an expense. So we should get that increase. So we shall do 6,200 minus 3240, 2960. So that 2960 will be a an allowable expense. We don't bring it here as an income. 2, we have rental income. So in the in the list provided, we do not have a rental income stated, but we have note 6. Note 6, the last bullet says, the company owns the building which houses its offices. Part of the office space is rented out to other tenants. In the year to 31st December 2020, the company received 2.8 million shillings net rental income from their estate agents, meaning the rental income received by the company from the estate agents was 2.8 million shillings. Then we are told property management fees amounting to 3.2 million shillings for the year ended 31st December 2020 had not been deducted. Now we know in taxation of rental income, property management fees is an allowable expense. So in this case, we are told the amount received as rental income from the agents was 2.8 million, but then this was before deducting property management fees of 3.2. Now, if you look at that keenly, this firm realized a loss from this rental business because the amount received was 2.8 before deducting a management fee expense of 3.2, meaning there was a loss of 400,000 shillings. So that cannot come here. It will go under allowable expenses. Remember, one of the rules in taxation of insurance business is that the specified sources of income clause does not apply. What is that? Now, the specified sources of income clause states that where a taxpayer has two or more sources of income at the same time, a loss from one source of income cannot be deducted as against, or rather cannot be deducted from other incomes. But then that is not applicable in taxation of circles. In other words, in taxation of insurance companies. In other words, if an insurance company has two or more sources of income at the same time, like in this case, a loss from one source of income for such a company can be deducted as a loss, or as an expense against the income from other sources. So that will come as an expense later on. Still on note 6, we have what they are calling interest from fixed deposit account of 780,000 shillings. That is an investment income which is taxable on a circle or an insurance company. So we write here interest from fixed deposit account. Interest from fixed deposit account. And we are told this was amount received of 780. We only receive interest income net of withholding tax. So what we do is to gross the amount. So we do 100 over 85 times the amount given. The amount given as having been received is 780,000. So we shall have 100 over 85 times 780. It means the gross amount, the gross taxable amount is 917.65. The dividends are received from qualifying company, meaning the 3 million, which we are told is net, is not taxable again. So what we do is to leave it out of this computation, and the rule is if you don't make use of any item in your computation, you have to give an explanation under notes and assumptions. So you can say under notes and assumptions that dividends from qualifying company, i.e. 3 million shillings net, is not taxable beyond withholding tax, i.e. it is a qualifying dividend income. We look for any other taxable income under general insurance. And from the table given, from the list provided, we do not have any other taxable incomes. Yes, so we get total income. That is net premiums plus other taxable incomes. Let's do that together. We shall have 7576 plus 8,000 plus 917.65. I'm getting a total of 16,493.65. So we call that total income. Total income. The next step is to deduct the allowable expenses. So we say less allowable expenses. Remember, we are using the gross profit approach. So we bring in all the allowable expenses at this point. So we go through the additional information first. Note 1 says claims outstanding for general business was follows. Claims outstanding for general business was follows. So we have as at 1st January 2020 and as at 31st December 2020. So we work out claims. So we run a small working 2. We can do it here. Working 2, I'm running claims account. So outstanding claims are liabilities. So then the balance brought down is credited. So we write here, balance brought down 6640. Balance carried down is 7 million shillings. Then you look for any other items affecting the claims account. So back to the list provided, we have what they are calling claims paid in the year. Claims paid in the year of 9.8 million shillings. 9.8 million shillings. Claims paid. Now, if you withdraw money from your bank account to pay for an expense, you create a bank account as you debit the expense account. So here we say bank 9.8 million shillings. Any other item affecting claims? Any other expenses affecting claims? We look at the list provided. If you look at it keenly, we have what they are calling recovery from a reinsurance company. That is claims recovered from the insurance company, meaning the company paid these claims to the insured, but then part of this were recovered from the reinsurance company. So that should be credited. So we write here, claims recovered. Claims recovered. An amount of 1.2 million shillings. So because that is the last item affecting claims, we balance off the claims account keenly. So we start with the debit side, that is 9,800 plus 7,000, a total of 16,800. We write that here, 16,800, 16,800, less 1,200, less 6640. We arrive at 8960 as the allowable claims for the year. So we write this income statement. That is the claims amount that should go to the income statement. So that is what we bring here from working 2. It is 8960. That is note 1. Note 2 says, general expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3.26 million shillings. Now these are capital expenditures which are disallowable, but we allow for capital allowance. So it means we have to work out the capital allowance allowable for the year. So that takes us to working 3. We write here capital allowance, working 3. We do that. So we consider in this case all the capital expenditures qualifying for capital allowance. Working 3, capital allowance. So 1, we have computers. Computers qualify for capital allowance currently at 25%. So we write here, computers is equal to 25% of 800,000. That should be 200,000. 2, we have saloon car. A saloon car is an non-commercial vehicle. So then the qualifying cost is restricted at 3 million. So we shall do 25% of 3 million shillings. That should be 750, I think. Let's confirm. 25% of 3 million is 750,000. Any other capital expenditure incurred by the firm under general insurance? We have none. So we get the sum of this. We call it total capital allowance. That is 950,000 shillings. That is what we bring here, 950,000 shillings. Next allowable item. Now, just before we go to the other one, we are told general expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3260,000. Now, if you are keen, total general expense under general insurance is 8,490,000. But then we have only been given a breakdown of two. That is 800,000 and 3,260,000. That's a total of 4,060,000. Now, it means there is another general expense which is not yet accounted for. So then we have to work it out. So we shall have 8,490,000 minus the sum of the two in note 2. That is, the sum of the two is 800,000 plus 3260. That is 4,060,000. So we shall have 8,490 minus 4060. That is 4430. This 4430 has not yet been accounted for. It is upon us to assume whether it is allowable or disallowable. If we assume these other general expenses are allowable, we would bring it here as other allowable expense. But we have to write that note. If you assume it is not allowable, we do not bring it here, but still we have to give a note under that item. So assuming it is allowable, so you write under notes and assumptions that other general expenses are assumed to be allowable. Other general expenses are assumed to be allowable. So in that case, we bring it here. So we say other general expenses. We get 4430. 4430. And with that, we are done with general expenses. We move to note 4, note 5 are about life assurance, so we don't use them here. Note 6 is about other incomes, which we have dealt with. So under that, in that case, we have dealt with all the allowable expenses from the additional information. The next step is to go back to the list provided and look for any other allowable expenses under general insurance. So let's start from up there. So we have premiums received, commission ceded, premium returned, recovery from reinsurance, premiums paid to the insurance company. We have commission expenses. Commission expenses are allowable under general insurance, so we bring that here. Commission expenses. The figure is 1,050,000. 1,050,000. Next we have management expenses, still allowable under general insurance, so we bring that here. Management expenses. The figure is 2,034,000. Next we have traveling expenses, allowable, assuming the travels were for business purposes. So we have to write that under notes and assumptions for us to bring it here. So you can say under notes and assumptions that traveling expenses are assumed to have been for business purposes, hence allowable. And the amount is 1.2 million. You could also assume the other way. If you assume they were not for business purposes, you would not bring it here, but you would say under notes and assumptions that traveling expenses are assumed not to have been for business purposes, hence disallowable. Next we have marketing expenses. Marketing expenses are allowable in business, so we bring that here. Marketing expenses. The amount is 314,000. Fees paid to investment managers allowable. Fees paid to investment managers. The amount is 900. We have claims, legal claims relating to legal expenses relating to claims allowable. Legal expenses relating to claims. The amount is 740. General expenses we have dealt with. Then we have bad and doubtful debts. Bad and doubtful debts are only allowable if they are specific. So here, we are not told whether these bad debts are specific or not. Again, for doubtful debts, or a provision for doubtful debts are only allowable if they are specific. So here, because it is just bad and doubtful debts, we could assume either way. So we can say that bad and doubtful debts are assumed to be for general bad debts and therefore disallowable. So that means we leave it out. Claims paid during the year, we have used to work out the claims in working 2. Then bonus utilized to reduce premiums are taxable incomes. We already have that here as 180,000. So it means in that case, this is the last allowable expense under general insurance. We get the sum of all the allowable expenses. So we add keenly. We have 8960. We have 950. We have 4430. We have 1050. We have 2034. We have 1200. We have 314. We have 900. And we have 740 finally. A total of 20,578. We deduct that from the total income of 16,493.65. The difference is 4,884,000.35. We double underline because it is the end of the working, and it is a loss. So we call this adjusted loss, or that net loss. Net loss. So because it is a net loss, it cannot attract tax. Now we know that tax is imposed on incomes, and for a business firm, income is profit. So because in this particular case, under general insurance, the firm realizes a net loss, that would not attract a tax. So we shall say that in part 2, or rather, sorry, the question does not want us to look for, to determine tax liability, but for illustration purposes, we can do it. That is under general insurance. Remember, the firm here has general insurance and life assurance. So we should move, therefore, to to life insurance or life assurance business. Remember, the question is the taxable income or loss for Triple Com Insurance Company Limited for the year ended 31st December 2020. So we said under that, we work out the taxable income under general insurance, we work out the taxable income under life assurance, then you get the sum of the two. So this is just under general insurance. So we move to life assurance. If I rub this, So I move to life assurance. Now, taxation of life assurance, the determination of taxable income under life assurance is a four-step computation which is done this way. One, we work out what we call, we compute the premiums receivable for the year. Premiums receivable for the year. So I will do it step by step so that we follow. So step one, that is, step one, compute premiums receivable for the year. Compute premiums receivable for the year. So I want us to be keen and do it together. Premiums receivable for the year. So if you look at the equation, we have what they're calling premiums received in the year. Premiums received in the year, that is under life assurance of 100 million shillings. So we say received during the year. Received during the year is 100 million shillings. Then we come to note note 5. It says outstanding premiums in respect of life insurance business were as follows. One, as at 1st January 2020 of 12 million and as at 31st December 2020 of 9.2 million. So what we do is to add the outstanding premiums at the end of the year and we deduct the outstanding premiums at the beginning of the year. So we say add outstanding premiums carried down, that is at the end of the year. Note 5, that is 9.2 million. Then we say less outstanding premiums brought down, that is 12 million shillings. So we get the net amount. We shall have 100 million plus 9,200 less 12 million. I'm getting 97,200 million. So that is what we call premiums receivable for the year. Premiums receivable for the year. That is step one. Step two is to compute what we call maximum allowable management and commission expense. So I move to step two. Maximum maximum allowable management and commission expense. So this is based on the premiums receivable during this. So we do this as per the Insurance Act. So you can continue and say compute maximum allowable management and commission expense as per Insurance Act as follows. So it's a step by step computation. So we say first 5 million shillings at 25%. So we get 25% of 5 million. 25% of 5 million. I'm getting it to be 1 million. 1,250,000. Then we say next 7.5 million. Next 7.5 million at 22.5%. We do that. So 22.5% of 7.5 million. I'm getting that to be 1687,500. 1687,500. Then we say next 7.5 million at 20%. 20% of 7.5 million is 1.5 million. Next we say next 10 million. 10 million at 17.5%. So we do 17.5% of 10 million. I'm getting 1,750,000. 750,000. Then the excess, that is the balance at 30%. So the balance at 15%. So we say balance. The balance now is this figure here less the sum of all this. That is 97,200 million minus the sum of all this. The sum of all this is 30 million. We can confirm we have 5 million plus 7.5 million plus another 7.5 million plus 10 million. A total of 30 million. So we say 97.2 million minus 30 million at 15%. So we do that. 97.2 million minus 30 million. I'm getting 67.2 million. We multiply that by 15%. I'm getting 10,080,000. Then we get the sum of all this. We have 1250,000 plus 1687,500 plus 1.5 million plus 1.75 million plus 10,080,000. I'm getting a total of 267,500. 267,500. So this will be the maximum allowable management and commission expenses. Step 3 is to compute what we call determine excess management and commission expense. So I want to move to step 3. Allow me rub step 1 and 2 so that we do step 3 and 4. So I rub this. So I move to step 3, which is we compute excess management and commission expense. Excess management and commission expense. So this we do like this. We determine the management and commission expense reported by the company, then we compare it with what we have just computed in step 2. So let's look at the list provided again. If you look at the list provided under life assurance, commission expense is 2,960,000, while management expense was 25 million shillings. So we do it like this. We say actual amount incurred. Actual amount incurred. We do it like 2,960,000, yes, plus 25 million. That will be a total of 27,960,000, 27.96 million. Then we say allowable. We compare it with the allowable. Allowable is what we have computed in step 2, and we got it to be 16, 267.5. So the difference is what we call excess management and commission expense. So we do it. We have 27,960 less 16,267.5. That is 11,692,500. That is step 3. Step 4 is to compute what we call taxable income. So I do step 4. Step 4, compute taxable income. So we do that like this. One, we have we have to present it in the form of an income statement. So allow me wrap this, then I prepare an income statement so that we work out the taxable income under life assurance. So allow me to wrap this. So we are now in step 4, the last step. Compute taxable income. So the name of the company is Triplecom Insurance Company Limited. Taxable income computation for the year ended 31st December 2020. So we start with amount transferred to the life fund. That is at the end of the year. So we say amount transferred from life funds. That is as advised by the actuary. So we move to note 4 of the question. It says the life assurance fund balance was valued by an actuary at 310 million shillings as at 31st December 2020. 8% of this fund balance was recommended to be transferred for the benefit of shareholders. So that is what we used. It was the amount at the end of the year. So we shall do 8% of the fund balance at the end of the year, which we are told is 310 million shillings. So we work out that we shall have 8% of 310 million. I'm getting 24.8 million shillings. We write here 24.8 million. 2, we have what we call 30% of excess management and commission expense. 30% of excess management and commission expense. So we go back to step 3, where we computed the excess management and commission expense. If you are keen, we got it to be 11,692.5 million. So we do 30% of 11,692,500. You work it out. 30% of 11,692,500. I'm getting 3,507,507 0.75. That is 3,507,750 shillings. Then we get total, the sum of this, get total income. So total income in this case will be 24.8 million, that is 24,800, plus 3,547.75. I'm getting 28,307.75. And that becomes the taxable income under life assurance. Remember, the question is the taxable income or loss for Triple-Com Insurance Company Limited for the end of this. So what we do, we add this to whatever we got under general insurance. Therefore, total taxable income of the company, total taxable income will be the taxable income from life assurance, which we have as 28,307.75, plus the income from general insurance. But we realize a loss from that, so we say less, and it was 4,084,000.35. 4,084,000.35. So we work it out. We shall have 28,307.75 less 4,084.35. I'm getting 24,223,400. Now, if the question asked you for tax liability, we would simply multiply this total taxable income by the corporation tax rate given. But in our case, it has not been asked. But I hope you remember to do it. This is a company, so we use the prevailing corporation tax rate. That marks the end of question 2. It was testing you on taxation of insurance business, which is a subtopic under advanced aspects of taxation of business income. So revise that keenly. It is a must in the exam. If you are keen, you must do at least 2 questions from that particular topic. So both question 2A and question 2B were from the same topic, testing you on different subtopics. That marks the end of question 2. And in our next session, we shall be looking at question 3.
Hello learners, welcome to our today's session of Revision Management Accounting December sitting. In our previous class, we were looking at question number 2, and today we are looking at question number 3 of the same sitting. So welcome, have your calculator. Let's walk through together. Question number 3, part A, reads as follows. The cost accountant of ABC Limited has provided the following information relating to production of a single product branded Z. So we've been given details for 3 periods. That's period 1, 2, and 3. We have production in kilograms, sales in kilograms, opening stock in kilograms, and closing stock in kilograms. Then additional information note number 1, the financial details for 1 unit of Z based on the normal activity level of 30 kilograms are as follows. So we have the cost per unit for direct materials, labor, production overheads, and the selling price per unit. Then note number 3, we are told that administrative overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. Then required, prepare operating statements using Roman 1 variable costing. So we want to begin from there. Roman number 1, variable costing. So in management accounting, we have 2 methods of costing that we use, and one is a variable, or what's called marginal costing, and then the other one is called absorption costing. So in variable costing or marginal costing, we normally include variable costs only in the cost of sales. So when we are computing the cost of sales, ensure that we are separating the fixed cost and the variable cost, so that we only consider the variable production cost. And that's what we are required to do. And since we have 3 periods, we need to show all the periods on one sheet. So we'll not prepare for period 1, 2, and 3 separately, but to show it as one statement. So you can prepare that. So this is ABC Limited variable costing income or operating statement. Variable costing operating statement. So we were not given the year. If we had at the year, then we say for the year ended, but we do not have that. So we all have that included. So we have period 1, period 2, and period 3. So for each period, we'll have 2 columns. So we have 3 periods, which will show it all together. And so we begin with the sales. So we normally have the format for preparing the operating statement. We will have the sales, we less the cost of sales, we less the closing stock, the cost of sales, we less the fixed cost, and we'll be able to get the net profit. So we calculate the sales. We are beginning with the period 1. Period 1 sales were 30,000, and in note number 2, we are told that the selling price of product Z is 9 shillings per kilogram. So to calculate the sales, we are taking 30,000 multiplied by the selling price of 9, which will give us 270,000. Can put in thousands of shillings, so that we have smaller figures. So we have 270 as the sales for period 1. Then we less cost of sales. So cost of sales comprise the opening stock. When you look at the question, period number 1, we were told production was 30,000, sales was 30. And then we do not have any information about the beginning inventory. So we assume that there was no opening stock. So we just put a nil where we have opening stock. Then we add production cost. Production cost will comprise variable production cost only. So the main variable production cost as given in the question is, we have direct materials. We were told that it is 1.5 shillings per kilogram. So when we are calculating the variable costs we base on production. So we take 1.5 multiplied by 30,000. 1.5 times 30,000 kilograms, and that will give us 45,000. We also have direct labor. We have direct labor, which was 1 shilling per kilogram, and production was 30. So 1 shilling multiplied by 30 will give us 30 shillings, 30,000 shillings. Then the next one is production overhead. Production overheads. So the production overheads that we are including are the variable production overheads only. In note number 3, we were told that the administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. So meaning the 3/4 of the production overheads is variable. So we are to get that variable part, and that's what we will include in the cost of sales for that variable statement. So how do we calculate that? So working 1, we are calculating the variable production overheads, which is simply variable 2/3 of 2/3 of 3 shillings. A third is fixed, so means 2/3 is variable. So we multiply by 3 shillings, and this will give us 2 shillings. So to calculate the variable production overhead, this is our working number 1. Working number 1, we are taking 2 and we are multiplying by the production. So the production was 30,000 times 2, and that will give us 60. So we take 60, and then we add this. This gives us 135. Before we bring it here, this will give us 135. And this is the cost of goods available for sale. Then we less closing stock. So we were told that production was 30,000, sales were 30,000, meaning there was no closing stock. So we have nil stock, and therefore the amount will simply be 130, which is our cost of sales, and then we subtract it from the sales to give us what we refer to as contribution. So contribution is simply sales minus the cost of sales. So when you subtract this, you'll get 135. And once we get the contribution, we less all the fixed costs. So in variable costing, whether it is a production fixed cost or a non-production fixed cost, we subtract it from the contribution. So we are to identify the fixed cost in the question, and we'll calculate the fixed. This is 2 fixed production overheads, which we were told that was 1/3 of that which was given, and this is simply 1 shilling. So we have fixed cost under which we have production overheads. And this is 1 multiplied by the production. Production was 30,000 multiplied by 1. And that will simply give us 30,000. We also have administrative overheads, fixed administrative. The administrative overheads are fixed at 25. So you add that, this will give us 55, and we subtract it so that we get the net profit. So the net profit will be 80. That's for period 1. We do the same for period 2 and 3. We do the same for period 2 and 3. So for period 2, the sales, we need to calculate the sales, which we are basing on the sales in kilograms times the selling price. So the sales in kilograms were 27,000 multiplied by 9 shillings. So this will give us 243,000. Then we are lessing the cost of sales under which we have opening stock. So we need to know whether there is opening stock. In period number 2, the production was 38,000. The sales were 27,000. So when you take 38,000, remember we do not have any closing stock from period 1. So when we have closing stock in period 1, this closing stock will automatically be the opening stock in the next period. So that simply means in period 2, we do not have opening stock. Why? We do not have closing stock from period 1. So for opening stock in period 2, we also put a 0. And I was explaining, we had 38,000 units produced, and we are told that 27 were sold, and then we have 11,000 remaining in stock, meaning there was no opening stock. From there, we add production cost. So production cost comprises direct materials. We are including variable cost only. So direct materials for period 2, we are taking 1.5 shillings. That was the cost per unit, and we multiply by production of 38,000. And this will give us 57,000 shillings. Then direct labor is given at 1 shilling per kilogram. So we take 1 multiplied by production of 38. 1 times 38, we will have 38,000. And then production overheads for period 2, we were told that variable production were 2/3. Still working number 1, 2/3, which gave us 2 shillings per kilograms. So 2 shillings multiplied by 38,000. 2 times 38,000 will give us 76. And then we add. So the total is 171. And in period number 2, we are told that we have closing stock of 11,000. So we need to calculate the closing stock value. This is working number 3, closing stock. Closing stock, this will simply be based on variable cost only. So we were told that closing stock, that is for period 2. Period 2. We have 11,000 units times. So the question is, what is the cost per unit? The question per unit, The cost per unit will comprise the cost per unit of direct material, the cost per unit of direct labor, and the cost per unit of production overheads, which we've already been given in the question. So we are taking 1.5, which is the cost per unit for direct materials, plus 1, this is 1.5, plus 1, that's the cost for direct labor, plus 2, which is the cost for production overheads. And what we get will be the value that we will use in period 2. So 1.5 plus 1 plus 2 will give us 4.5 times 11,000, and this is 49,500. So our closing stock here is 49.5. Subtract that. And this will give us 121.5. So 121.5 is the cost of sales, which we subtract from the sales. And this will give us 121.5. Then we come to fixed costs. The fixed costs, we say that was 1/3. Fixed production overheads, 1/3 of 3 shillings, which is 1. So we take 1 and then we multiply by the production. And production for period 2 is 38. So the fixed production overhead here is 38,000, and fixed administrative overhead remains fixed at 25. So add that, and this will give us 63. We subtract it from the contribution, and we'll get a profit of 58,500. That's for period 2. Then we move on to period 3. In period 2, we had closing stock of 49.5. So this closing stock will automatically become the opening stock for this period. So for opening stock, we have 40. Sorry, we've not calculated the sales. We begin from sales. So the sales for period 3, according to the question, production was 27,000 and sales were 38. So take 38,000 times the selling price of 9 shillings, which will give us 342,000. And then we less cost of sales, of which we have the opening stock. So the opening stock is here. Here is 49.5. This is the balance to be carried forward, which was 49.5. So we bring it there. Then we add production cost, and production cost is comprising direct materials. And the direct material cost per unit is 1.5, but production was 27. So take 1.5 times 27,000, it will give you the cost for direct material, which is 40.5. That's 40,500. Then direct labor is 1 shilling per kilogram. Production was 27. So 1 times 27,000, it will give you 27,000. We come to production overheads, working number 1. It was 2/3 of 3, which is 2. We take 2, we multiply by production, which was 27. So 27 times 2 will give us 54,000. And then we add that. So this will be equal to 171. Then 171 we see whether there is closing stock. In the question, we do not have opening stock. Production was 27,000. The sales were 38,000. So when you take the sales of 38,000 and then you subtract it from the 27,000 production, you'll realize that there was a deficit of 11, which was just the balance that was carried forward from the closing stock. So there is no closing stock in the period 3. So we subtract a 0, we subtract a 0, which will give us 171. We subtract 171 from the sales, and it will give us 171. Then we less the production overheads. Production overhead, working number 2, production overheads, working number 2, we have 1 shilling times production of 27, and this will give us 27. Then administrative overheads are fixed at 25. So we add that, and this will give us 52 shillings, which we then subtract from 171 to get a net profit of 119. And that's how we use variable. So a point to remember in variable, we are including variable production cost only. When we compute inventories or stocks, we use variable production cost per unit only. We don't include any fixed portion. And that was Roman 1. Then we move on to Roman number 2. So Roman 2, we use absorption costing. So the company is ABC Limited. So we begin with the sales. So how is absorption costing different from marginal costing? We have 3 main things that differentiate between marginal and absorption. In marginal, we have said we are separating fixed cost and variable cost so that what is included in the cost of sales is only variable. In absorption costing, the cost of sales will comprise both fixed and variable components. So long as it is a production cost, we consider it both as fixed and variable. Again, in absorption costing, we have what we refer to as product cost and period cost. Product costs are treated, in absorption costing, we treat fixed costs as product costs. But in marginal costing or variable costing, we are treating fixed costs as period cost. When we expense them when they are incurred and in that period in which they are incurred. And the last item that differentiates between variable and absorption, in variable, we do not have application of absorption of overheads, but in absorption costing, we have application of the principles of absorbing cost, which is making it different. So we begin with the sales. The sales are calculated in the same way. So for period number 1, we have sales of 30,000 and the selling price is 9. So when you take 9 and multiply by 30,000, we get 270. Then we less cost of sales. So the cost of sales will comprise opening stock. So we didn't have opening stock in period 1, so we put a 0. Then we add production cost. Production cost consists of direct materials. So the direct materials for period number 1, is 30 times 1.5, which gave us 45,000. We add direct labor, and direct labor was 1 shilling per kilogram, and we had production of 30, which is 1 times 30, and that's 30. Then production overheads. So when we come to production overheads, we are not separating fixed and variable. In the question, we were told that production overheads was 300% of labor, and that the amount is 3. And in note number 3, we were told that administrative overheads are fixed at 25,000 per period, whereas a third of production overheads were fixed. So in marginal or variable, we were separating that. But in absorption, we don't separate. Why? So long as it's a production cost, whether fixed or variable, we include it in the cost of sales. And therefore, to calculate production overhead, we are simply taking 3 and we multiply by the production, which is 3 times, this is workings, 1. We are taking, this is production overheads. This will simply be 3 shillings times 30,000 kilograms, and that will give us 90,000. So we will have 90,000 and not 60 as in the case of variable. Then we add so we have 165. We have 165, which is the cost of goods available for sale. Then we less closing stock. Closing stock in absorption costing is based again on both fixed and variable, but according to the question, there was no opening stock. So there was no closing stock, so it is 0. We subtract that and we get 165, which is the cost of sales. When we subtract, we now get what we refer to as gross profit and not contribution. So the gross profit will be 105, and once we get the gross profit, we will consider whether there is any over or under. So we add over absorption. Over absorption arises when what we absorb or what we charge is more than what is actually incurred. So when you read note number 1, we were told that the financial details of one unit of product Z based on a normal activity level of 30,000 kilograms. So it means the details we have were based on the activity level of 30,000. So whenever a company produces either more or less than that, it means there will be either an over or under absorption. But in period number 1, we will not have an over or under. Why? This firm produced 30,000, which is equal to the normal level of activity. So for over absorption, there is a nil, and then under absorption will also give us a nil. So this is subtracted, over absorption is added, under absorption is subtracted to give us the adjusted gross profit. So our adjusted gross profit is 105, and from there we less all the expenses. So in management accounting, expenses are simply referring to all the non-manufacturing costs. Any non-manufacturing cost is considered as an expense. So according to the question, in note number 3, we were told that administrative overheads are fixed at 25,000. So our expenses here are simply the administrative overheads, and is fixed at 25. So you subtract that, and what we get will be the profit, which is 80,000. That was for period 1. We do the same for period 2. The sales remains the same. Sales made were 27,000. 27,000 times 9 gave us 243. Then opening stock, since we do not have closing stock in period 1, opening stock is not will not be there. We add production cost, which is comprising direct materials. So direct materials were 38 times 1.5, which gave us 57. Direct labor was 38,000 times 1, which gave us 38. And then we need to calculate production overheads. This is working number 2. So production overheads was working number 1, and then still working number 1, production overheads now for period 2. Period 2, we are using the same formula. We are simply taking 3 multiplied by the production units, in this case, which were 38,000 kilograms. So 3 times 38,000 will give us 114. So production here will be 114. And then we add. This will give us a total of 209. So something to note is the production overhead is 114, and the production was more than that of the normal activity level. We were told that this data provided is based on the level of 30,000. And so if we were to rate the actual amount should have been 90,000, which is based on the activity level of 30,000. But now here we have 114,000, which is above that. So it means that we will have an over-absorption. Why? What we are absorbing, or what we are charging, the 114 is greater than what should have been charged under the normal, which is 90. So when we are absorbing more than that which is actual, then we have an over-absorption. Of how much? Of simply the difference. So we show the over-absorption of overheads, which will be equal to 114,000 minus that of the actual